It's 9 a.m. here in New York City. I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance Live, and here's what we're watching this morning. Up, up, up. Markets continuing to climb after the Dow notches a fresh high. But today's triple witching threatens a volatile day of trading. Could the rally be at risk?
Plus, Hong Kong stocks ending the week on a high note thanks to investor optimism on China's stimulus efforts. But the latest data signaling much more may be needed to revive the world's second largest economy.
And General Motors laying off more than 1,000 workers across two plants in Michigan. The car maker previously delayed production on two EV pickups, bringing one of its factories to a standstill. We're going to have more on that here in just a little bit. But we got to start with the massive rally that we've seen in the markets. The everything rally is on. The Federal Reserve giving investors their ideal scenario at Wednesday's meeting, signaling that rate cuts in 2024 could be likely at this point. And with inflation falling, the labor market holding steady, and consumers remaining resilient, stocks seem to be on track for a Santa Claus rally. But will the hype continue into the new year? Well, our next guest seems to think so. Oppenheimer has one of the highest targets on the street for the S&P. Their year-end S&P target for 2024 is 5,200. We want to bring in John Stolfus, the man behind that call, Oppenheimer Asset Management Chief Investment Strategist. John, it's great to see you. So let's talk about the bullish outlook that you have for 2024. Why are you confident, or what makes you, I guess, so optimistic at this point that some of this momentum is going to carry into the new year?
Well, first of all, thanks for having me on the show, Shauna. We're positive on this because we really feel that what we saw this year has been the reestablishment of fundamentals that justified the market moving higher, going back to levels that haven't been seen now since prior to the sell-off that we saw last year. And at this point, fundamentals likely to continue into next year, remaining positive as the Fed remains vigilant against inflation, but also remains, as it has been this whole Fed funds hike cycle, except for when it raised rates at 75 bips 4 times in a row. Essentially, what you have here is a Fed that has been very sensitive as to how its mandate affects the economy. So we think that's what really carries this. It's not a robust economy, but a resilient economy, evidenced by business and the consumer, with jobs still remaining plentiful, even as that jobs number has come down, and the likelihood that this will bode very well for revenues and earnings, not only for the S&P 500, but likely for other major indices, including mid caps and even small caps.
And so, John, you were kind of giving us some indication of how much this call that you've made also relies on the Fed. How many cuts, though, does it also rely on from the Fed potentially?
Actually, Brad, much fewer calls than the traders will tell you are coming up. We think next year the Fed likely remains on a long pause or a long skip, as it has been this year, with the likelihood that in the second half of the year is when we'll see the cuts, and in that second half, maybe 1 or 2 cuts. The biggest problem being that, with higher wages, people continue to spend, and the ability to remove all that stickiness and inflation might be tougher to find, but nothing overly negative, we think, for equities in terms of Federal Reserve action.
John, you mentioned their earnings just a moment ago. When it comes to some of those positive trends that we have seen over the last quarter or two up until this point, what do you think earnings growth looks like as you look ahead to 2024?
Yeah, we were looking for, we'd readjusted our earnings target down from 230 to 220 for 2023. So we think probably about 9-10% upside in earnings growth next year to around 240. And we think that really occurs as companies remain remarkably adept at navigating an environment with advanced technology, whether it's to curb costs, to improve logistics, manage logistics or manufacturing processes. And we think that the earnings will take us, that makes our multiple on that 5,200 target about 21.7 times where we stand now on a forward basis, but likely more attractive, a little bit less than that by year end next year.
What are the hot spots that you would tell investors to keep an eye on going into next year?
Yeah, well, in terms of hotspots, as in positive, Brad?
Oh yeah. We want the good. We want the good stuff, John.
Technology remains a leader in here. But technology, as its role pertains to all the technology can do for the other 10 sectors of the 11 sectors, or really, if you look at it, the other 9, because communication services is about 50% technology, as I recall off of the top of my head. So you've got infotech and communication services really empowering the other sectors, whether it's a growthier value company or a garpier growth company, essentially empowering them to maintain their premise to attract investors. In addition, and that would be technology, consumer discretionary, industrials, and we think the financials, certainly in a revival period here after a tough year from earlier this year. We've seen now this quarter financials performance improving.
John, when you take a look at the outperformance that we've seen lately of small caps, some optimism there creeping back into the market. We have talked to a number of strategists saying that small caps really have room to run as you look ahead to the new year. What do you think that upside looks like?
Well, we think the upside for small caps really at this point would be probably a little bit more modest than the large caps here. Depending upon how high the Fed maintains interest rates into next year and how that affects refinancing for many of the small caps. We think you need to look at the small cap indices. We prefer the S&P 600, which is a higher quality small cap compared with the Russell 2000. The Russell 2000 runs hot when the tide comes in and all ships float, as we've seen of late. But the S&P 600 also participates, and we think that S&P 600 for small caps, S&P 400 for mid caps look like good places to be. Both of these segments, in terms of sub-asset classes, have been disfavored for quite a while. But as we normalize, that normalization process should be good for that space, we believe.
John, I've been rounding up New Year's resolutions from some of the top chief investment strategists like yourself. I would love to know yours and what you would tell investors to heed going into next year.
I think practically a mantra is beware of darkness. It's sort of a play on what George Harrison used to sing. We have to, on any pullback, recognize that it can create an opportunity to find babies that get thrown out with the bathwater, or good quality stocks that are just sold off in any kind of a downdraft. And we'd add to that, stocks do not go up in a straight line. And this rally that we've had so far in the fourth quarter likely to be tested. But again, the fundamentals and the Federal Reserve look very supportive, as well as secular trends or longer term trends in technology, as well as the need for intermediate to longer term investment for generations, both the boomers, who will be alive longer in retirement, likely than previous generations, and for the millennials and younger, in preparing for retirement many years ahead of that, looking for equities to be a more competitive source than fixed income for growing intermediate to long-term assets.
Well, I think a resolution for any generation and for all of us, we should resolve to stop throwing babies out with bathwater. That's just terrible, John. John, appreciate the time here on The Morning. John Stoltzfus, who is the Oppenheimer Asset Management Chief Investment Strategist. Great to see you, John.
Thanks.
Well, traders are bracing for triple witching today, the fourth and final of the year. Stock options, index futures, and index options all expiring the same day. Typically, such days bring unusually heavy volume and volatility. So can this derail the rally here? It's a big question, especially as we've considered the rally that we have seen that has been hinging on the Fed and their tenor changing, and the likelihood of a cut being talked about even more so, as well as the economic data that's somewhat supportive of that to this point.
Yeah, I think maybe we could see a little bit of volatility here going forward, at least just in the very immediate term because of this, but I don't think it's something that's really going to shake the confidence here of investors. We've talked time and time again just about how bullish some of the commentary or the rhetoric we heard from Powell was for the markets this week. It was exactly almost what investors had wanted to hear from Powell. We saw that reflected in the massive gains that we saw following the press conference on Wednesday, and then of course that carrying over here yesterday and through to this morning. So we will see how today's trading day played out. But we were just talking to John Stoltzfus there, who has a 5,200 year-end target for the S&P next year. One of the highest, I believe, on the street, along with Tom Lee. You compare that to some of the other maybe more bearish outlooks when you take into account that JP Morgan only has about a 5,200 target for the S&P next year. Morgan Stanley 4,500, lower than where we are today. So I think investors are still all over the map because so much of this obviously hinges on what the Fed does. There's lots of optimism right now in the market that the Fed is going to, in fact, cut rates next year. The market actually pricing in potentially 6 cuts in 2024. The Fed likely, because of the dot plot, signaling we could see 3 cuts. So there is a bit of a disconnect there. How much of that, though, optimism is already priced into the market, I think is a big question.
I mean, anytime you have more calls like the one that we got from Morgan Stanley, and they were looking more at some of the global growth stocks, but when you have some of the calls like that we got from Morgan Stanley in a buy the dip type of mentality, that mentality typically only prevails in a strong rally mode type of environment, and that's exactly what we're seeing right now.
Exactly what we're seeing right now. All right, well, let's talk about another big story that we're watching here this morning internationally. You have Hong Kong stocks ending the week on a high note, boosted by calls for more stimulus and a string of economic data painting a clearer picture of the nation's recovery. Industrial output rising in November ahead of analyst expectations in a bright spot, but weaker than expected retail sales data and also a still struggling property sector suggests that more support may be necessary to boost China's recovery. Here with more, Yahoo Finance's Madison Mills. Maddie, we have been talking about this time and time again, just about the sluggish recovery playing out in China, exactly what is necessary going into the new year to help that momentum a little bit.
Well, I think it's also important to note that this is not the same stimulus that we got here in the U.S. that we remember, and you guys know this, but as a reminder to our audience, this is not the same as, consumers getting a check in the mail. This makes it cheaper for central banks to get loans, which they're using to buy government bonds, which gives Beijing more money to play with for fiscal stimulus to come heading into this coming year. So the question is this liquidity that we're seeing going to the government, to corporations, going to hit consumers? And we're obviously not seeing that when we see the dip in retail sales, that surprise to the downside. And if you look at this data compared to 2019, we continue to see surprises to the downside, not just in retail sales, but also industrial production. And we also have talked a little bit about how the property sector in China is not doing so great. So they really need to see consumer spending in these other areas to make up for it, you guys.
All right, waiting for some China trickle-down economics there, perhaps. Also, we got comments from Treasury Secretary Yellen about the U.S.-China relationship. What can you tell us there?
Well, it's interesting because Yellen has to talk about the continued relationship between the U.S. and China, right? And she's talking about efforts to decrease that drama heading into the following year. But she also talked about the importance of increasing transparency from Beijing when it comes to their economic plans. And this is something that is always a difficulty when dealing with China. The U.S. needs them because production coming out of China is so affordable and manufacturing is so affordable, but you just never know what is going on with Beijing, frankly. And we've seen that over the past year with issues with China and Russia and not understanding that relationship geopolitically. I also was in the Middle East covering the handshake between China and Iran last year, which was another surprise for folks. So you just don't know what is going to come from Beijing, particularly under Xi Jinping. And so that transparency that she's hoping for is something that people have wanted forever from China. And so the question is, what is she going to do to get it?
Absolutely. All right. We're going to continue to watch to see how that relationship plays out. Many more years to come. But thank you so much for encapsulating what the latest movement there is. Maddie Mills, appreciate it. Also, we're tracking Citigroup this morning. Citigroup shutting down its municipal bonds business. The bank told employees in a memo that the business was no longer viable, according to several reports, aiming to complete the closure by the end of the first quarter. Yahoo Finance's David Hollerith has more on this. David, good to see you.
Hey, Brad. Yesterday, the bank's head of markets and interim head of banking said in this memo shared with us that the economics of the municipal's business, the activities are no longer viable, given their commitment to increase the firm's overall returns. So at a high level, this is right in line with, or maybe just a piece of what Citi has been trying to do for years now, since CEO Jane Fraser took over, which is a sweeping restructuring of the bank in order to return it to profitability. Again, the municipal's business is effectively the business of banks helping local and state governments finance infrastructure projects like roads, bridges, and schools. And so in the city memo, the bank's head said that it will continue working with current municipal clients, and it will also continue investment banking activities in private and public partnerships in sectors like transportation, healthcare, and clean energy. This decision comes after months of review, the memo had said, and the municipal business in general is said to be ultra competitive and very dependent on timing with public policy, generally a tough place to make money from what I gather from other commercial bankers at a couple other big banks. So the wind down will be completed by the end of the quarter with employees in the municipal sales, trading, and banking unit set to leave in the coming months. As Bloomberg initially reported, there has already been an exodus of bankers from the team to investment bank Jefferies. The move is reported to affect in the ballpark of 100 employees.
Yeah, David, when we talk about that, this is just an area. The reason why it's so significant is because Citi really had dominated this market for years. So it is just in line, or just another thing in terms of how the business is pivoting and how the bank looks so different under Jane Fraser. But talking about some of those projects there that you mentioned, what this division was used for, talk to us just about some of those famous projects that it helped paid for and the impact that this division has had over the years.
Sure, yeah, and this is kind of the conflict of what's going on here. The decision for Citi to get out of municipals is that, for a while, Citi, one of the biggest banks, was huge in this business. They were a part of helping New York City finance the bond, or sort of underwrite the bonds for the One World Trade Center in the aftermath of the 9/11 attacks. They also helped Detroit install streetlights across the city about a decade ago. And those kind of projects really stick out to the average American and show how banks can step in. That being said, these projects aren't always positive. So they can come across as negative. Back in 1987, Citi got out of its lending business with the South African government under apartheid, and they were one of the last holdouts. So it just goes to show this is really seeing a bank stepping in and being a part of taking a lot of power and sort of showing how they can work with governments. It's not always positive, but it does leave a big impact and impression to the average consumer on what they can do.
All right, Dave Hollerer, thanks so much again. Citi exiting the muni market, a story that we are tracking here this morning. All right, David, thanks. Well, more layoffs coming to General Motors, the automaker announcing that the cuts will be coming early next year and impact around 1,300 workers in total in the state of Michigan. This coming just one day after the company cut 24% of its cruise division. Now, these layoffs that are being announced today, not necessarily a huge surprise. It's also important to point out that this also follows just about a month after the company reached that massive deal with the UAW. But when it comes to these two plants, Brad, and the employees that are going to be affected, the one plant, the Lake Orion plant, manufactures the Chevy Bolt, which is going to stop production here by the end of the year. That plant is going to be idle as they look ahead to try to transition it to prepare it for producing electric pickup trucks here in the future. So a number of these workers, unfortunately, being laid off as a result of that.
Yeah, one of the huge things that we were tracking, especially coming off of the negotiations with the UAW, was how the automakers would look across the total headcount that they had at many of these factories and try to understand, okay, for a lot of the initiatives that we've set forth, whether that be in autonomous driving, of course, a far off goal that many of the automakers have discussed, and some of them rolled out in some facet or another, whether that be electric vehicles, where they've set multi-year targets and unfortunately been met with a market demand profile that's been vastly different, perhaps early innings, than what they anticipated, and needing to make sure that they're securing margins for right now. For the amount of headcount that they had, it was likely that they were going to go into the negotiation tables, say, okay, we're comfortable ultimately, once they netted out a deal, with a set target, and we saw what the numbers were once the UAW finally got deals with GM, with Stellantis, with Ford as well. And you just had this sense that they were going to look across each of these plants and figure out, okay, well, where do we need to start rolling back the headcount in order to actually deliver upon much of the financial targets that we've just signed off on and ratified with the existing and remaining members now at this point too.
Yeah, and that coupled with the fact that demand for EVs isn't necessarily where they were hoping it would be at this point. It's caused GM, it's called Ford, it's caused a number of these automakers to scale back their EV plans, at least for now. And of course, that affects the workers that they had planned to work on those production lines. All right, we'll keep right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. We'll be right back.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
The increased cost of capital from the Fed's interest rate policy has been a headwind for companies across the board. One industry particularly susceptible to that is solar power. Those stocks haven't had a great run this year, but the Fed's so-called pivot certainly changes the game. Today, Jefferies initiating a slew of those stocks with a buy recommendation, including First Solar and Sunrun. Yahoo Finance's Madison Mills has the detail. Hey, Madison.
Hey guys, so the headline from Jefferies this morning is all aboard the solar coaster. And as we've been talking about, this is one of those sectors that is really going to benefit from the decrease in interest rates coming from the Federal Reserve. So what's interesting about this initiation of coverage from Jefferies is not only confirmation of what we've already been hearing on the street, that solar stocks could be in for a great year in 2024. It's also confirmation that banks are really starting to get behind the anticipation of Fed cuts coming sooner rather than later. But zeroing in on some of these names that we've got from Jefferies here, they're looking at First Solar, Enphase, and Sunrun, and they're starting to see again some of those tailwinds coming from those Fed rate cuts. Also, we've got Array, Sunrun, SunPower here. Taking a look at First Solar in particular, you can see really struggling throughout the course of this year, but starting to see an uptick today. They're actually having the most volume on the stock that they've had in weeks here as Jefferies is initiating that coverage. And you can see that pop into the green this morning. In pre-market, they're up about 8%, which is a great day for them over the course of the past month. Interesting to note also from this morning's coverage of Jefferies, they say that First Solar is their top pick. That's because of some of the fundamentals here. They've got a strong backlog, supportive pricing in this declining price environment. They've also got a good balance sheet and some good margins as well. So just another reminder that the fundamentals still matter even when a broader sector group is going to be performing well.
Yeah, Maddie, we know interest rates clearly has been a massive factor in the underperformance of a group of these names here over the last year. So that seems to be likely here to improve in 2024. But there's also just intense competition, especially when you take a look at what's coming out of China and in Europe, what we're seeing play out there. That, though, I think will likely be one of those challenges. Is that similar to what you're hearing and what a lot of the analysts are saying up until this point?
Well, what's interesting to your point, Shauna, is that in the note they talk about how they're less interested in the residential plays. They're more interested in broader company-driven plays for these solar power installations, which makes sense because that's going to be a lot more bang for their buck when it comes to installation. And those bigger projects are going to get better margins when it comes to the decrease in the interest rates that these solar power companies are going to have to pay on their loans to install those bigger, broader solar power projects. So it's interesting to see them kind of transitioning away from a bet on consumers going solar and more to more industrial, bigger plays in the space. And that's where they're seeing more of the demand to come heading into next year. So we're going to be hearing a lot about that on these company earnings calls. And I think the ones that can talk about that bigger stream of demand coming in from those bigger budgets from other companies are the ones that are going to benefit the most heading into 24.
All right, Maddie, thanks so much for that. Let's take a look at the futures here. We're just about 2 minutes until the opening bell, and we are still looking at gains, at least for the Dow. Looks like it appears it's going to open just above the flat line, but the action, at least in the pre-market, a bit muted here this morning. This comes after what has been a very active week in the markets here. Investors encouraged by what they heard from the Fed on Wednesday. The likelihood, the dot plot signaling 3 cuts next year. That was enough to push indexes here to a rally. We had the Dow at a record high. Question now whether or not some of that momentum is going to continue. We certainly have seen a broadening out of market participation this week, a trend that we saw really pick up here over the last several weeks. Let's head over to Brad Smith. Brad, you got a closer look at some of these movers here ahead of the open.
I do indeed. Yeah, here over at the Wi-Fi Interactive. All right, let's load up some of those futures as we're taking a look and just ticking down until the opening bell here on Wall Street. This is happening on a kind of slow news day, as there's a lot of perhaps malaise across many of the typical market movers coming off of their holiday parties or whatever may have been. But anyway, taking a look at the Dow futures, you're seeing that flat just barely to the downside right now by hair, but it's chinny chin chin. The futures for the Nasdaq just barely barely ticking into the red there as well here. We're down there by about, actually, we're oscillating, hyper oscillating on the Nasdaq 100 futures. There you're taking a look over the kind of activity that we've seen here leading up to the bell. S&P 500 futures right now pointing lower, as well as you were mentioning a moment ago. We're going to take a look at some of the hot spots just once we get on the other side of the bell here, but I'm loading up the heat map ahead of time because I'm hyped, Shauna. I'm excited. Can't wait. Take a look at these happy hype people over at the New York Stock Exchange. Ticker symbol ZKH ringing the bell there. And then you've got what I believe is Bonsai ringing the opening bell over at the Nasdaq there. So happy groups of people. We love to see it. And funfetti on a Friday. All right, so let's take a look back at some of the major averages here as we begin today's trading activity. I'm taking a look at, first and foremost, the Dow Jones Industrial Average, everybody's favorite safe word. Taking a look at the Dow, right now it's flat, just barely to the downside, down by about 0.2% out the gate. Nasdaq Composite, you're seeing that open up the day higher by about 0.2%. And then the S&P 500, that's down by about 0.2% to start off the day. I promised you sectors, we're gonna give you sectors. Let's take a look at the S&P 500. 11 sectors loaded up here for you on the screen, folks. And utilities pulling up the caboose. All right, they get a down vote today by about 0.7%. However, taking a look at staples and technology, you're taking a look at a move higher of about 0.1%. Let's put that on a full week look, 5 days. How about that for staples? We're seeing that up by about 1.7%. All right, good news there. XLK, get out of here, staples. It's moving around so quick. All right, there we go. XLK, Vanna White would be so upset with me. We're taking a look at technology right now. That is up over the past 5 days by about 2.4%. However, here out of the gate, up by about 0.2%. Lastly here, I want to take a look at the Nasdaq Composite, see where some of those mega cap tech stocks are moving this morning. I'm also going to zero in on Intel in a moment there, coming off of their AI day yesterday. Also, Apple, let's start things there because a lot of people are going to be talking about that at brunch over the weekend. Why not? Apple, you're seeing that lower by about 0.2%. Past 5 days, still higher by about 1%. Microsoft, Google, you're seeing some fractional moves there. Google can't figure out its mind right now. Microsoft up by about 0.5%. And lastly, I mentioned Intel, so we'll end things there. Things are jumping around there, but there you're seeing Intel. It's up by about 2.5%. Again, coming off of that big AI announcement day yesterday. We'll have much more from those conversations later on in the show.
Brad, look at you back at the touch.
It's been a while.
Like you never left.
I had to dust off a couple cobwebs and everything, but you know.
Pro, man.
Yeah.
You did well then. We got to send you over there a little bit more often. All right, let's talk about this rally that Brad was just speaking of here that has been really playing out on the street over these last several weeks. We saw the Dow hit a record high this week. Hints of rate cuts from the Fed sent stocks soaring with major averages on track for their 5th straight week of gains. Well, our next guest thinks some of this upward momentum is here to stay, calling for all-time highs in 2024. Let's take a look at the technicals, and we want to bring in Rich Ross for that. He's Evercore ISI's Senior Managing Director. Rich, it's great to see you. We want to start with one of the charts that you sent over. It was of the S&P 500. Right now, we're trading just above 4,700. What are you seeing on a technical basis?
Well, look, the S&P is in an outstanding technical position, and it continues to get better here into year end. So what we've seen over the course of the year is a market that continues to confound the skeptics. And one thing we see is that after a bear market, that's typically what happened. Obviously, we had a very sinister bear market decline, but it really checked the boxes in terms of both price and time. What we've seen historically, and what we also see historically, is that coming out of those bear markets, the first real test of the nascent bull market comes in around those all-time highs, around that 4,800. So we see us testing those levels in early 2024, but really the backdrop continues to improve, and obviously we've seen that acceleration this week in terms of getting us to that year-end target of 5,200 by the end of next year.
What are some of the strongest catalysts that you're pointing to, and is it the same of what we've seen this year where you've got a lot of kind of the AI chats within tech that's really kind of pushed, and does that also permeate and extend into next year?
Well, I'm operating under the belief that the strong will stay strong and the weak will get strong. And that's how breadth expands. That's how you get to that 5,200. This year, we know this story. The Magnificent Seven have carried a lot of the mail for this market, but importantly, they also dominate the market cap of the S&P. Now, markets can remain narrow, but not in perpetuity. They need that breadth to expand, to sort of feed the fire, and that's what we're seeing. How do we get breadth to expand into the hardest hit corners of the market, the most interest rate and economically sensitive corners of the market? Well, you get interest rates to go down, and that takes the foot off of the economy, onto the accelerator, off of the brake, that is. So that's what we're seeing here as policy peaks, inflation peaks, rates, the dollar, crude. All the bad stuff is peaking, and all the good stuff, which is stocks, is bottoming. And that's what we're looking for next year. The strong across tech and growth stays strong, but the weak across retail, regional banks, the Russell 2000, real estate, all interest rate and economically sensitive, they will get strong.
And Rich, we also want to take a look at one of the charts that you sent over, and it has to do with Microsoft. You're saying it's landing in your highest conviction idea. What are you seeing there that makes you so optimistic about a name like Microsoft?
Yeah, well, it's our key theme all year has been macro peaks drive a Microsoft landing, sort of a play on words there, maybe funny only to me, but also profitable, with Microsoft up 54% year to date, outperforming the S&P's gaudy 23% return. So what do we see here? We see a stock in a very classically bullish position here, breaking out from a multi-year base of support. You don't need to be a technician to appreciate the gravity of this breakout, almost a cup and handle, if you will. We don't know if those work. We just like to say it. But the key point is when stocks are at an all-time high, both absolutely and relatively, breaking out from a multi-year base of support, with those macro headwinds turning into strong tailwinds, that's a stock you want to buy. And when that stock is the second biggest stock in the S&P at over 7% of the benchmark average, it's like starting every day on first base when you're a bullish strategist like myself.
Lastly, Rich, while we have you, we also got to take one more look at one more chart that you sent us, and it's the trader of the lost arc on a breakout above 50 here. You got to take us into this one. Great names, though, by the way, of these charts.
Yeah, thank you. Thanks very much. If you can't make them money, make them laugh in this business, at the very least. So the key point about ARC here, look, it's been a lightning rod of controversy, both on the way up back in 2020, post the election, the announcement of the vaccine, the world reopens, and what happens? ARC goes straight up, and things that go straight up tend to come straight down, in particular when you have a historic inflationary surge and 500 basis point policy move over the past 2 years. And now those forces are receding. So what we're left with ARC is a 3-year bear market. Keep in mind, peaked in early 2021, and the calendar tells me it's almost early 24. So a 3-year bear market, you lose 80% of your value, you build a base over 12 to 18 months, and then those top-down macro forces that drove the bear market not only recede, but turn from headwinds to tailwinds in terms of the policy pivot, the peak in inflation, and what happens. That which goes down 80% and falls for 3 years starts the long climb back, much like that Nasdaq tech bubble did after the 2000 to 03 decline. Sorry to block the camera there for our viewers. And then after 03, you kind of stick your cleat in the turf, and here it is 21 years later, and the Nasdaq's still going.
Excellent breakdown. Thanks so much for joining us here this morning, Rich Ross, Evercore ISI Senior Managing Director. Appreciate the time. So rate cuts appear to be on the way, even if we don't know exactly when, and that should weigh on the U.S. dollar, but some investment banks are warning of strength for the greenback in 2024. Yahoo Finance's Inez Ferre has been digging into this one and has the details for us. Hey, Inez.
Hey, Brad. Yeah, and we have to take this into the bigger context of what happened this week. We saw this rally this week on the heels of what the market anticipates is the Fed pivot, that the Fed will be cutting rates next year. And if we take a look at our Wi-Fi Interactive, take a look at what happened to the DXY. This is the U.S. dollar index against a basket of currencies. That's including the euro, the Japanese yen, the British pound. And here you see the dollar coming down after the market says, okay, the Fed's going to cut next year. But Fidelity, JP Morgan, HSBC, Morgan Stanley analysts are saying, hold on a second. In 2024, you will likely see the dollar rise as the U.S. economy outperforms. So what these analysts are saying is that compared to the rest of the world, the U.S. economy will outperform. Other economies in emerging markets will be struggling as with these higher for longer interest rates. And this is emerging markets and also Europe. And they will go into a recession. So if the Fed cuts interest rates next year, what these analysts are saying is you will probably be seeing other countries that will have to reduce sooner. That is going to create a wide rate differential. And when that happens, you will see a flight to safety to the dollar. So only if you see a soft landing globally will you get a bear case for the dollar. Now, I'm going to pull up a 2-year chart here so you can see that last year, remember when the markets were going down? The US dollar was going up. And here we go. As the markets were going up this year, the US dollar was going down. And here you see here this leg with the US dollar going down now. Bloomberg has a survey out that says that they have analysts that have a consensus across 10 countries that they think that the dollar will be weaker in 2024. Currencies in other countries in the US dollar index that I was just talking about, that most of those currencies will rise. But these contrarians from, again, Fidelity, JP Morgan, Morgan Stanley are saying what you're missing here is that there will be a flight to safety as other countries weaken. And you've got Fidelity's money manager that says that Europe and the UK are going to go into a recession, that the dollar always gets a bid when that happens. You also have Morgan Stanley analysts that are predicting that the US dollar index will reach 111 by next spring. Right now, it's at 102. That's an 8% rise, guys.
And that would certainly be a huge headwind potentially here for many of those multinational companies. Inez Ferre, great stuff. Thanks so much for breaking that down.
Thank you.
Let's take a look at some of the trending tickers today. And first up, Lennar. Shares of that are falling here this morning, off just about 2% shortly after the open. The company reporting its fiscal fourth quarter earnings on Thursday. Now, despite beating the street's expectations on revenue and earnings on steady demand for deliveries, the home builder reported a gross margin that missed analysts' expectations. Also, the gross margin forecast for their fiscal first quarter came in a bit weaker than expected. We're seeing that reflected in the share price action today, under a bit of pressure. We also got to point out, though, that Lennar went into this report with shares at an all-time high. So we're seeing a bit of a pullback there. We have seen a lot of this momentum here play out within many of these home builder stocks. New home sales have really helped steady maybe a struggling housing market here over the last several months. We have seen a bid here just because of the fact that so many existing homeowners, they aren't moving from their homes because they're locked in at lower rates. That's leaving home builders, the new home sales, to really pick up that demand that still remains out there. So we have seen a bid for these home builders in this environment. Of course, a lot of that future momentum hinges on the fact of whether or not we're going to see an improvement on the mortgage rates. We had the 30-year mortgage just above 7%. So a bit of improvement in terms of the highs that we saw about 2 months ago, but still much, much higher than what we saw play out during the pandemic.
I mean, you hit the nail on the head with the mortgage rates also impacting the demand environment. And the thing that'll make you say, golly gee willikers, when you look at this report is the fact that the backlog kind of quarter over quarter here, you were taking a look at a backlog previously of about 21,000 homes, dollar value of about $9.9 billion. You take a look at this quarter, sure, they've moved through much of delivery on that, but the backlog now sitting at just south of 15,000 homes, dollar value now sitting at $6.6 billion. So what does that tell you? That tells you that there are not more buyers that are actively coming into this market and increasing that backlog that this company can then deliver on. So that is something that investors would look out to and say, okay, ultimately, where is that buying capacity going to come in from? And what do the home sellers, what do the home builders need to do in order to offset what some of those customers are going to be paying in the mortgage rates over an extended period of time with the real price that they're paying up front? And so that's where you're seeing more of that moderation, perhaps even in pricing, even just to get some of the homes started as well.
Yeah, we've seen many of these incentives, a lot of those just in terms of lowering prices. Yes, it is pressuring margins, but names like Lennar, they're taking that hit on the margin level, trying at least to boost the volume of sales. It's enough for now, but whether or not that's going to be enough as you look ahead to 2024 and investors take a second look at some of the pressure that we are seeing on margins as a result here of some of those incentives that they're offering, you got to think it's going to pressure the stock at some point.
Absolutely. We're also watching shares of Rocket Lab this morning, the stock falling 9%. The aerospace manufacturer launched its 10th Electron rocket of the year. The mission, called the Moon God Awakens. We'll get back to that. It took off in New Zealand today, deploying a satellite into orbit. That makes 2 Earth-observing satellites in orbit in part of what will eventually be a 26-satellite constellation to monitor Earth every 10 minutes. This is the company's 42nd Electron launch in its history. The name of this launch caught your attention this morning, too.
The name of the launch caught my attention. What was it? New God Awakens?
The Moon God Awakens.
God Awakens. It caught all of our attention. I mean, how could it not? But when you take into account what this means, the significance of this, why we're seeing some excitement reflected in the share price here this morning is just because Rocket Lab is second, obviously, to SpaceX. Now, there's a wide margin in terms of the number of launches and what we have seen from the two companies this year. But looking ahead to 2024, Rocket Lab plans for just about nearly 24 2024 missions. So this could be the start of a little bit more activity within that space. We know that this is really a key test in their ability to maybe one day challenge what SpaceX, a space that SpaceX has been dominating now with its Falcon 9. So this successful launch, we're seeing some of that excitement, at least initially, but shares off now just about 9%, but did launch another successful mission here this year before the end of the year.
You know, one of the stronger comparisons that investors might be apt to look towards with this company too, and just to see how they've performed, is Planet Labs. This is a company that went public just a few years ago, and you think about ultimately the wave of SPACs that we saw around that time. Well, ultimately, Planet Labs was one of those, the D-SPAC that came about, and it has sputtered into obscurity, unfortunately, at this point. A lot of similar launches, imagery that it's looking to get from Earth orbit, and I think for the business models, the launches are expensive. You need to continue to rely on an environment where more of these business-to-business customers are potentially buying into your imaging services, and how do you grow out more of that service space as well here in this space. I think that's something that just continues to be a head-scratcher maybe for some investors that are out there. By the way, the launch that took place prior to the Moon God Awakens, the name was, my goodness, okay, this one was the Japanese God of the Moon. Yeah, okay, interesting.
There's a theme there.
There's a theme. They like moons.
They do like moons. But again, shares, we saw it really spike yesterday.
Yeah.
So I think the drop of 9% is kind of just a come back to earth type of moment, maybe.
Yeah,
for
bullish
some
on the
shares,
moon,
at
though.
least for today. You can see that spike play out in the stock yesterday. All right, we'll keep right here on Yahoo Finance. We've got all your market action ahead. Stay tuned. We'll be right back.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
Olive Garden's parent company Darden Restaurants posting a beat on earnings and raising its annual guidance as consumers turn to the dining chain for value offerings. Yahoo Finance's Brooke DePalma here with us. And Brooke, when we take a look at the price action, we just had the stock there up on the screen. We're seeing it under a bit of pressure here this morning. A lot of that has to do with some of the guidance that we heard from the company.
Yeah, the call roughly underway now, and they did update their fiscal 2024 financial outlook, but they did come in at the lower end of their sales range there. They now expect same restaurant sales growth for the fiscal year 2024 to come in between 2.5% to 3%. They do expect total sales of approximately $11.5 billion, but they cited check softness that's being offset by lower inflation, which is why they went to that lower end of their sales range while increasing their earnings outlook. But they did say that they are seeing traffic similar to the levels that they expected earlier this year. As you can see right here, Olive Garden, a big business opportunity for them. Consumers flocked for their never-ending possible promotion this past quarter. They said that they were offering it at the same price point they did last year, but they actually saw even more guests come in for that promotion this year. That Longhorn Steakhouse also was a big winner, up at 4.9% in terms of same restaurant sales growth, but fine dining did see softness, down 1.7% as a whole. They said that that continues to be challenged year over year. They said that fine dining was actually being dragged down the most by negative check mix year over year by less people consuming alcohol. Very interesting there. Wow. They said that basically the preference for alcohol today is exactly consistent with where it was pre-COVID, and last year it was a lot higher. I know, believe it or not, that's the truth.
Sorry, I was laughing at Brad's reaction. He just cannot handle the fact that people are consuming less, Brad.
Possibly.
Wow.
And it's dragging
this
check size
environment?
at fine dining.
My goodness, you've got people dropping the R word every day. How could you not? All right, well, we'll leave that to the side here. We'll see if they talk about the New Year's Eve rager that takes place at Olive Garden in Times Square.
They did say holiday bookings are doing well so far.
People pay a heck of a lot of money for the
maybe that's it. Yeah, maybe that's encapsulated within there. Let's talk about Costco while we got you, Brooke, here. A good American company also posted a beat on the both top and bottom line in its first fiscal quarter earnings results and revenue came in at $57.8 billion. That's up 6% year over year, while adjusted earnings per share also came in higher at $3.58. So what can you tell us here?
Yeah, well, Costco continues to hold on to that share that they gained during COVID as consumers really flocked to the wholesale giant for value and bulk items. And so what we're seeing here is sales were positive for the quarter. They did come in slightly less than expected, but there were some top takeaways from the call that really gave us insight into what we're seeing in the larger environment. They said that inflation was in the range of 0 to 1% last quarter. They said that it's slowing down. Bigger inflation, deflation rather, came from big bulky items like furniture, where we're seeing lower freight costs, ultimately into lower costs for furniture. That also helped TV prices decrease. Of course, discretionary items have been something that people are moving away from. Now they're a bit cheaper. They said that they did sell more units there, and they said that they're pressing their vendors to lower costs because of these lower commodity costs. We're also expecting a new CEO, Ron Varkris. He's going to join the helm on January 1st. He is currently COO and president. He has held that role since February 2022. And also, when asked how they expect this CEO change up to be, CFO Richard Galante said on the call that he expected it to be pretty seamless. Ron has been with the company since he was 17 years old at Price Club in Arizona. He's been with the business for more than 40 years. And that looming membership fee hike, we haven't seen one in more than 6.5 years. Typically, they raise membership fees every 5 years and 7 months. So now we have moved past that. The CFO acknowledged that. He said that all the variables are in place to raise membership fees, including strong renewal rates, strong new signups, and strong loyalty. But he relied on his age-old answer of it's a question of when, not if. We did see paid household members increase yet again 7.6% last year. And so consumers continue to go to Costco to score that value deal.
All right, so that means one way or another, you're paying just a little bit more for that $1.50 hot dog soda. I'm sorry, it's factored in. Brooke, thanks so much for breaking this down. Appreciate it. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Stocks are setting up for the fifth straight weekly gain as investors bet on future rate cuts from the Fed. But our next guest says that for the bull market to continue, other stocks must catch up to the Magnificent Seven. Dana Deoria, who is the investment co-chief investment officer, joins us now. Great to have you here with us this morning. First and foremost, what would be the catalyst for the rest of the non-Magnificent Seven to catch up with the type of fervor that we've seen for those names?
Yeah, thank you for having me. I think, well, we're in it, right? The Fed coming out with such a dovish series of remarks, and of course the market completely overshot on what was actually said. Now pricing in 6 rate cuts, and all of that is meant to happen not because there's a recession. We're still pricing in kind of this soft landing as well as these rate cuts. So I think that does it, right? And that's why we're seeing all of a sudden these stocks that hadn't been participating through the course of the year starting to catch up lately, because a lot of that too, some insight is, looking at just what was happening through the course of the year with large growth versus small growth. Seeing about higher rates theoretically impact growth stocks because they mean that they have to discount future cash flows for all those, future earnings. But we saw that far more happening with small growth, where they're probably not cash funded. They have to rely on capital markets more. So now with expectation of rate cuts, all of a sudden you're seeing those stocks participate. So I think we're experiencing it, but it is pricing in a very rosy scenario.
Dana, when you take into account this rosy scenario, what seems to be really driving the market's momentum between now and the end of the year, looking ahead to maybe some of those risks that linger outside of the fact if we don't see the participation from more of those stocks outside the Magnificent Seven, what's on top of your radar?
I think timing, right? And just, kind of the way that these things play out historically. It doesn't jive really with kind of behavioral finance, I guess, right? And what people see when they look at the current market. But really, it's not atypical for unemployment to be low at this stage in a cycle. It's not atypical that, there's kind of this complacence to a certain extent after, the rate hiking cycle that we've had. These things, impact the economy at a lag. So a lot of companies termed out their debt, and they haven't had to go back to capital markets yet at these higher rates. But that's coming. We know it's coming. And in spite of, maybe money supply not being terribly restrictive from a historical perspective, it's more restrictive for sure than it was. So I think, it's just that lagged effect of a lot of what's already happened coming into the market.
What would need to happen for the Magnificent Seven to see that kind of next leg higher here? Because I think for all of what has transitioned in the hype phase and now into the show me story for a lot of the generative AI kind of fodder the conversation and so forth, 2024, it seems like there's going to need to be delivery, maintenance of, and continuity for a lot of that sentiment to prevail and push these stocks even higher.
I completely agree. In your comments earlier in your broadcast, I mean, I think, the problem with AI is that the expectation that it's suddenly going to massively increase productivity, I think, is putting a lot of expectation on something that is, at the end of the day, relatively new. Most companies don't yet know how they're going to make benefits from AI, even if the benefits are possible, right? So, markets are short-term in nature, and if we're pricing in, particularly into the Magnificent Seven, an expectation and, right, the NVIDIAs of the world, if we're pricing in an expectation that the AI boom happens sort of next year in terms of actually see, the economics, the corporate finance aspect of things, I think it's a lot to expect, and again, you're pricing a very rosy scenario in there. That's not to say that the long run potential of this technology is not massive. It's just, the expectation of markets for it to happen so quickly.
So, Jane, if you do expect to see a broadening out here in terms of participation, where do you expect that leadership to come from?
I think, as I say, the beaten down stocks, these small cap companies that, hadn't participated, and just, massive gap between what you were seeing in the large cap growth, for example, and small cap growth. I think now there's some catching up that happens with that. And I largely tend to advocate, just because if you're a long-term investor in the market, which, you know, our clients are meant to be, then you're thinking in terms of what's my long-run expected return potential. I tend to advocate for, you know, a tilt towards small value. It's not a prediction that it's going to pop in 10 minutes, but that you get some bang for your buck. I mean, it's kind of a basic tenet of finance that if you buy low, you have a higher expected return in the, you know, kind of medium term space. So I think there's opportunity there for sure. And certainly if you've been really focused and concentrated in the Magnificent Seven, or even market cap weighted, where you're getting a massive amount of Magnificent Seven, whether you know, ask for it or not, tilting towards some of those smaller, more value stocks. And these stocks as well have the added benefit that, you know, they tend to outperform inflation over time. If you just look historically, and, you know, inflation's looking great right now, right? But inflation tends to come in waves, and it's very difficult to say for sure that, you know, we've really put the nail in the coffin on that.
Yeah, it certainly has, and we heard that reflected a bit from Jay Powell on Wednesday. Well, Dana Deoria, great to have you here, Envestnet Co-Chief Investment Officer. Thanks, Dana. We'll keep right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned.
Welcome back to Yahoo Finance Live this morning, everyone. Brad Smith alongside Shauna Smith live in New York City, and we're about 30 minutes into the trading day. Let's take a look at how things are shaping up. Stocks rallying this week, but markets are seeing a mixed picture this morning. The Dow is eyeing a third straight record high as the prospect of deeper and earlier interest rate cuts continues to brighten some investor spirits out there.
All right, let's take a look at some of those individual names. First up, Clorox shares are on the move this morning. Bank of America upgrading the stock to neutral from underperform. The team also raising its price target to $150 a share. That's up from $120. Well, Bank of America is seeing volume and shelf space recovery, boosting Clorox's annual growth rate over the next few years.
Scholastic shares falling after cutting its full-year revenue guidance on lower spending at its school reading events. The children's book publisher expects revenue to be relatively flat compared to prior expectations of 3% to 5% growth.
And NVIDIA getting some bullish calls from both Bank of America and Bernstein. Bank of America naming NVIDIA one of its top chip picks for 2024, saying that, quote, it's early to predict a peak. Bernstein singing a similar tune, the team remaining very bullish on NVIDIA's long-term prospects. All right, well, we have been hit with a slew of economic data to end 2023, a jobs report that showed a still robust labor market, cooling inflation prints, and a more dovish Fed. Stocks reacting very well to this news. We're looking at another rally this week, and it's keeping investors' spirit alive. But there's still some uncertainty on the horizon. We want to bring in Scott Stewart, Sageview Capital's founding and managing partner here, to weigh in on what we can expect looking ahead to 2024. Scott, it's great to have you here. So let's talk a little bit about the uncertainty that's on your radar. How is that shaping your investment playbook as you look ahead to the new year?
Great. Thanks for having me on. So we are private investors. We try not to focus too much on the macro, but I would say that at the moment, the market environment, the economy are feeling much more optimistic. The latest report from the Fed, the latest report from a number of Wall Street analysts about expected rate cuts, all of that turns what was a headwind since March of 21 into a tailwind. I would say at our companies, we're starting to see a pickup in business. Our companies are largely software. And we certainly feel like we're bottoming out and in fact seeing a pickup in business. So that's our outlook from the ground. It matches, I think, a little bit of what people are saying about the general market and the general economy.
It's interesting, especially because on the business side, from the software companies that we've heard from even earlier this week, it sounded like there was some uncertainty about what that propensity to spend from some of their portfolio clients would look like going into next year. Where are you kind of seeing that net out, and ultimately, how would that pass through to some of the valuations as well?
Well, I would say that, software market is not one company, right? Mm-hmm. So, for example, we have companies that have a demonstrable return on investment for our customers. They save the companies money. They improve their ESG status. Companies like DriveWise who sell software to truckers so they can bypass way stations. That means the trucking companies save a lot on labor and fuel. It's good for the environment. It's good for the bottom line. We have another company called SpecRite that sells product specification software to big companies who make things. Once again, that reduces costs and increases their ESG reporting. So I think businesses like that, even in a tougher environment, are going to do well. Some businesses that are involved in marketing and advertising and new business, I could see how customers are going to be much more cautious about buying that software.
Yeah, Scott, talk to us a little bit more about your investment criteria when you're trying to identify attractive names in this type of current environment. I know you're very company specific, but what does your investment criteria look like as we look ahead to 2024?
Sure. So the first thing I would say is it's great to invest in technology companies because there's really an endless supply of new ideas. We've been riding the software wave since we started our firm. And software is just a great piece of technology that can produce better results at a lower cost. I don't think that wave will slow down at all. I think that's a long-term trend that's here to stay. A lot of those trends will be exacerbated by AI. And while it's early days, we're already seeing at our companies that you can employ AI to lower costs. You can replace people, you can generate content more cheaply. So we're already seeing sort of the back office effects. And now we're turning our attention to what can AI do for companies that are trying to grow faster.
Productivity has been the early kind of selling point for a lot of the generative AI efforts that have come into the market. What is that next kind of catalyst that kind of unlocks the ability for some of these solutions to be sold into and continue to be sold into a lot of the businesses out there that were aiming for more productivity, and then once they see that productivity, what is the next leg?
Right. So like past waves in technology, I think it'll be multifold. There's a lot of talk about how AI will be able to replace white collar jobs. So you can envision coders, lawyers, accountants, those people could find. I don't really believe that AI will replace people, but I think it will empower people and make them more productive. And if any of these projections by the bulls come into reality, and I think they will eventually, there's going to be a massive capital expenditure program around the country. I mean, NVIDIA is sort of the canary in the coal mine, but if you think about the data storage and computational power that's needed to realize all the dreams of AI, you're just talking about a massive capital expenditure boom. So I think like in past tech waves, everyone's scared that the newest technology is going to put everybody out of business and be bad for the world. But time and time again, technology waves come and go, and productivity is improved, and employment is still strong. And I don't see, this is different in a lot of ways, it's more sophisticated, but I don't see the AI trends being any different ultimately.
Scott, when you take a look at what has been happening over the last several months, you talk about valuation, you talk about the fact that this is a very tough environment for startups. We did see bankruptcies tick much higher, especially over the last month or two. Are you seeing that in the software AI space, or is that a little bit more insulated from your view?
No, we're seeing it. So, just to step back for a minute, in some ways we had the mother of all bubble up until March of 21, when all the global monetary authorities, had basically had free money. And in environments like that, companies that don't really have great business models get cheap or free capital and go into business. That all changed in March of 21. You can see that companies are now valued not just on growth, but on efficient growth. There's a metric called Rule of 40, which is the growth rate in revenues plus your operating margin. And the markets are, now all the valuations are correlated to Rule of 40, not just growth rate. And to your point, I just saw a statistic that 3,200 venture companies went bankrupt this year. And those companies had a total of $27 billion invested in them. Another interesting statistic I saw from Silicon Valley Bank is that companies that raised money in 20 and 21, 70% of them have to raise money by the end of 24 and virtually 100% by 25. So that means there's going to be a ton of companies coming to the private markets trying to raise more capital. And this is my fifth correction. And I think our job is to figure out which of those companies have good business models and which have bad ones. And at SageView, we're fundamental investors, we're long-term investors, we back winning entrepreneurs. And our job is to identify the winners, give them capital so they can grow organically, and in fact, maybe acquire some of their wounded competitors.
Really solid insights, especially going into next year. Scott Stewart, SageView Capital, founding and managing partner. We appreciate the time here today.
Thank you. Great to be with you guys.
Likewise, thanks. Well, We're also tracking KKR and what they're saying this morning. KKR says that investors should approach markets with a glass half full mindset as we head into 2024. Despite geopolitical tensions and macroeconomic headwinds, the firm is recommending positivity prevail here. A few of the themes that ultimately they were pointing out in this global macro outlook, and one of them following some key tailwinds underpinning the team's continued constructive view in 2024. They believe the bear market in equities is well behind us, October 2022. I don't think they're going to find any challengers out there, and returns tend to be on average after about a 25% decline in the S&P 500 for the next 5 to 7 years. So they're thinking that for this cycle bottoming in Q2 2023, despite their forecast for a significantly slower nominal GDP in 2024, there's a lot of opportunities out there: industrial automation, security of everything, intra-Asia connectivity. So all of these things really propelling them to have a glass half full and positivity prevail. Everybody, just as Aaron Rodgers would have said way back when, relax.
Relax.
Yes.
I think everyone can take maybe that advice a
little
little bit.
Yeah.
But they talk about the dispersion that we've seen in the performance of some of these asset classes, right? And they talk about some of that opportunity here looking forward. And they do identify the fact that even though we are in this uncertain environment, we were just talking to Scott Stewart from SageView about that there just a moment ago, they are seeing a reason to be optimistic. They also mentioned earnings for this cycle bottoming in the second quarter of 2023, despite their forecast for what they're expecting, which is significantly slower growth for GDP for the U.S. economy as you look out into 2024. So they're saying you have to stay disciplined. That is the theme that we have heard from a number of our strategists over the last several weeks. So there are areas of the market that do provide an investment opportunity. There are reasons to be optimistic, but you do have to be a bit diligent in terms of what you are buying, why you are buying, because of that uncertain economic environment and the fact that we don't really know what exactly next year is going to look like, obviously, but especially when it comes to Fed policy.
They couldn't help themselves. They had to talk about artificial intelligence in this too. They said some of the most compelling opportunities in AI are the build out of physical infrastructure needed for generative AI to scale, reach full potential as well. This includes data centers, this includes semiconductor manufacturing, power transmission, distribution, among other areas. So those, for the generative AI curious out there, could be some of the areas that, as according to KKR, keep your mind on and your eyes on going into next year.
Yeah. And decarbonization, also one of their top themes as well. Very bullish on that. All right, well, we got to leave that there, but keep it right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. Intel hosted its AI Everywhere event on Thursday, unveiling new chips and attempting to cement its place in the highly competitive AI chip sector. Dan Halley, Yahoo Finance's tech reporter, sat down with Lisa Spellman, Intel's corporate vice president and general manager of Xeon Products and Solutions, to discuss the announcement. Here's what she had to say.
It's exciting for us to be delivering generation after generation of improvements, and especially focused on what we consider our customers' most important growth areas and workloads. Like, this is where they're betting their business. So we really focused on increasing the AI performance in this generation and building that foundation layer. And the other area is in improving the performance per watt. So we've increased the performance, increased the cores, increased the memory, all of that at the same thermal envelope, we call it. And that means that customers are able to get better sustainability, they can hit their EGS goals, and then they have this opportunity to just fundamentally have more efficient infrastructure behind all their cool solutions that they're delivering.
So one of the concepts was AI in every core, right?
Yes.
So what does that mean to have AI in every core of this chip for the regular person?
Yeah, well, what it means is that you have an incredible asset that's running all your IT infrastructure. It means that you have the flexibility to not only run your standard IT workloads, but to use this Xeon that you have deployed for generations. You've got, thousands of them, millions of them, across the ecosystem, in every cloud, in every network, storage, all over the place. And every single one of them can now be used to also run your AI workloads. So it just gives a tremendous amount of flexibility, and it means you don't have to do anything special. Like, you don't have to go buy something different or special to do your AI work. You literally can do everything you need with AI just with the stuff you already have.
So how does this compare to a dedicated AI accelerator?
Yeah.
Something like a GPU or
right.
something like that.
Yeah. The way we think about it is when you look at AI or generative AI, which has just blown up this year.
Just a little bit.
It's been a bit of a hot topic. You may have heard of it. What you see there is you see different types of problems being solved. And you see massive problems like a ChatGPT-4, and that is something where it's built to answer literally every question in the world. That problem size is so big, that data set is so big, that it actually really does benefit from dedicated accelerators like a GPU, like a Gaudi, things like that. When you look at a more common enterprise type of solution, so think of like an airline reservation system chatbot, or a financial services chatbot, or something like a healthcare recommender for treatment for personalized cancer treatments. Those are trained on a much smaller amount of data. Your doctor is not asking, hey, can you help me with this cancer diagnosis, as well as what's the best, show to see on Broadway.
Yeah.
They're really focused, and so that's the type of stuff that runs great on Xeon. The solving the world's big problems, but it's a smaller data set.
Right. So it's instead of just a broad grand thing, the Broadway show, how do I slow cook, pork roast, something like that. It's going to be dedicated into these individual kind of categories.
Yep.
I guess, when it comes to the overall AI hierarchy of a system, right? Everybody talks about, NVIDIA's the AI company, right? Yep. Where does Intel fit into that, a general server setup?
Yeah, actually this might be a little bit of an unknown fact. We work with NVIDIA because all of those GPUs actually run on a foundation of a Xeon server. That's what it's built on. So it is important to have both your CPU and your accelerator, working together, tested together, validated. We want to give that great performance. And with some of those solutions we're delivering from Intel, over time we're working to just continue to improve the way they work better together. And so we want to give customers that absolutely seamless experience and the ability to easily move from your AI on your Xeon into your AI on, like a Gaudi. And the way that would happen is if your problem set grew. So maybe you start with something, we call it, parameters. So maybe you start with something that's 7 billion parameters. It grows to 20 billion parameters or 50 billion. Well, you can just seamlessly move it. And we're trying to do all the software and solution work to make that super easy for people.
When it comes to training and inferencing, right?
Yes.
Just, so people know, training is teaching this language model or AI model. Inferencing is actually putting it into place in a company. Where does Intel fit in there? Is it more for the training? Is it more for the inferencing? And I guess which is better overall for just volume.
Yeah. The inference market is actually bigger. And it's growing really fast. Training is super important because you have to get the answers right. You have to work through all that data. But you do that once, and then you might revisit that training once a week or so as new data comes in. But the inference is happening all day, every day, as questions get asked, as the work gets done. So that's why inference has grown so much and keeps getting bigger. A tremendous amount of the world's inference already runs on Xeon, and we're trying to make that better and higher performance every single generation. In the future, you will see also inference and training working on accelerators also, because again, the size of these problems will have a lot of variability. So at Intel, we have our dedicated accelerators that are much more focused on delivering those really high performance training capabilities. We have Xeon that does great at fine tuning, so adjustments to that training, and then really specializes in inference.
So where do we see Xeon going in the next 2-3 years with regards to the kind of AI explosion, right? 2023, generative AI, all anyone can talk about. AI's been around for a while.
Yeah.
I guess in the next 2-3 years, where do we see Xeon with regards to that?
Yeah, if this year taught us anything, it's that this is going to be an incredibly fast-paced, fast-changing space for a while. Like where we are today is not an end state in any way. And so I believe that the flexibility we're building into the next couple generations of Xeon will be very impactful and helpful for our customers. So today is all about 5th gen, but I do look forward to unveiling some cool improvements we have coming in 2024 as well. So we'll be back talking as we look to just increasing that performance, the amount of capability, and especially sharing more about the software work we're doing. Again, all under that umbrella of how is it easy as possible for our customers to adopt and take advantage of this performance.
Our thanks to our own Dan Halley for bringing us that interview. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Markets rallying this week after Fed Chair Powell signaled rate cuts are on the horizon in 2024. That planned pullback, it comes at a key time for President Biden as he gears up for the 2024 presidential election. With us now to discuss all things Bidenomics, Rick Newman. Hey, Rick.
Hey, guys. President Biden needs a break, and he might be getting it from the Federal Reserve. Every president would love a little bit of help from the Federal Reserve. If you remember back to Donald Trump, he was always hectoring the Federal Reserve to loosen up and cut rates. Richard Nixon famously pressured the Federal Reserve to loosen up in 1972, which contributed to inflation later that decade. Biden has been silent on the Federal Reserve, but he looks like he's going to get some help from the Federal Reserve anyway. So what we saw this week, investors have been waiting for this for months. The Fed signaling finally, we think the fight against inflation is over. The so-called dot plot suggesting that instead of any more interest rate hikes, there could be rate cuts in 2024. And this is kind of just what Biden needs, because a little bit of loosening would goose the economy just a little bit and keep things looking pretty good for consumers. Of course, he needs inflation to come down further. But if the Fed is saying we're done hiking interest rates, they're basically saying we think inflation is going to fall back into the normal range within 6 or 9 or 12 months. So good timing for Biden. This doesn't mean this is exactly the way it's going to work out. We could still end up with a recession. But for now, the prevailing narrative, obviously, is that a soft landing is in.
Yeah, Rick, let's talk a little bit more about those risks as you look ahead to 2024, because yes, this is a win or could be a win here for President Biden, but there's a long list of uncertainties that are ahead. And when you take a look at the polls, he's trailing former President Trump by a wider margin here, at least in some of the results that we got out earlier this week.
Yeah, I mean, the number one thing that could go wrong is that the economy could soften too much and we could end up in a recession, which would be characterized by rising unemployment. I mean, the unemployment rate is below 4%. And if it stays below 4%, that's about as much as Biden could hope for as long as inflation continues to go down. But what if it goes up to 4.5 or 5%? And people who have been unnerved about rising prices, they have not been worried about job security very much, but it could flip. And, I keep thinking back to a year ago. The prevailing narrative a year ago was we're going to have a recession within 12 months. I mean, the Bloomberg forecasting model said there was a 100% chance of recession in 12 months. So that was obviously wrong, which suggests that now that everybody's saying, oh, we're going to have a soft landing in 2024, well, maybe that could be wrong too. But I think things right now are going Biden's way. And, one other thing to look at is gasoline prices, which, as we know, are the unofficial barometer of the national mood. They're down now to almost $3 a gallon. And as for Yahoo Finance has been reporting that they could go below $3 on average within a few weeks. So if these trends stay, this is about the best news Biden could have. He's got other issues. His age, number one, people don't trust him that much on the economy. But in terms of the stars aligning on the economy, it looks for now as if they are.
It could give him a boost here ahead of the election. All right, Rick, thanks so much.
Bye, guys.
Keep right here on Yahoo Finance. We got much more of your market action ahead. We'll be right back.
We're counting down the top 10 stories of 2023 here at Yahoo Finance, and coming in at number 2 is the Fed.
Over the past year, we've taken forceful actions to tighten the stance of monetary policy.
Do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me.
It's in your report, and that would be about 2 million people.
The Fed never promises anything.
The Fed probably has overdone it.
The Fed is feeling really good about the fact that inflation is coming down.
We are leaving 2023 in a much better place than most commentators and probably even the Fed thought we would.
The Federal Reserve had a lot of battles to fight this year, from stubborn inflation to questioning economists and angry legislators. Here to break down the ups and downs for the FOMC and its chair, Jerome Powell, is Yahoo Finance's Fed reporter Jennifer Schonberger. Hey, Jen.
Hey, Brad. What a difference a year makes for the Fed. The central bank began 2023 slowing the pace of its most aggressive rate hiking campaign to cool inflation since the 1980s. Now, as 2023 comes to an end, that campaign appears to be all but over. The Fed last raised rates in July to a 22-year high. But after holding rates steady for their third consecutive meeting this month, Fed officials predicted they would likely cut rates 3 times in 2024. The reason? Inflation is falling closer and closer to the Fed's target of 2%. Even Fed Chair Jay Powell, after months of sounding hawkish, turned slightly dovish at his last press conference of the year. Take a listen.
You see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly confidently and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore.
This pivot was months in the making. Fed officials warned for much of the second half of the year that they would need to see further progress that inflation was coming down before they could stop raising rates. Powell himself offered several warnings.
At last year's Jackson Hole Symposium, I delivered a brief, direct message. My remarks this year will be a bit longer, but the message is the same. It is the Fed's job to bring inflation down to our 2% goal, and we will do so.
Another warning came in September.
Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks.
And yet a third came on the 1st of this month.
It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease.
The shift that happened this week took many by surprise. It comes after several data points show inflation continues to drop slowly. Powell said at his press conference this week that rate cuts will be a topic of discussion looking ahead. Back to you.
All right, Jen, thanks so much for breaking all of that down for us, because we know the Fed has certainly been front and center for 2023. We have probably talked about the Federal Reserve and its chair, Jerome Powell, almost every single day of the year as the central bank has worked to get inflation back down to its 2% target. The FOMC's preferred tool in tackling this challenge has been to raise rates, which they brought to a 22-year high back in July and have held rates there steady for over 5 months, hoping to slow demand in the economy without driving the U.S. into a recession. So was the Fed successful? Here with more on that and what we should expect looking ahead to 2024, we want to bring in Lindsay Pieggs, as she's Stifel chief economist. We also have Vincent Reinhart, Dreyfus and Mellon, a chief economist. Great to have both of you here. Lindsay, let me start with you, just in terms of how successful the Fed has been in trying to address what has proven to be very sticky inflation. What grade would you give the Fed?
I would give the Fed a B right now, because we still have a lot of unfinished business. Mm-hmm. Inflation has come off of peak levels, but we're not at 2% yet. 3.5%, 4%, that's not 2%. Mm-hmm. And the last 100, 200 basis points is always the most difficult. So my concern is, while the Fed has done a good job opening up the table of potential policy moves to include rate cuts should inflation continue, I don't want the committee to prematurely declare victory before we get to that 2%. So we can't just hope inflation continues to recede. We need to ensure a return to price stability.
So, Vincent, too early to declare victory, but it seems like at least, and this is good for consumers and perhaps for the economy as well, that the Fed is at least winning the battle against inflation.
So the grade is incomplete because they're not at their goal of price stability of 2%. Certainly the case. I think the key feature of 2023 about disinflation is it was actually a lot easier than they thought. Jay Powell admitted it at his press conference after this FOMC meeting. They went into it thinking it was going to be hard. Just listen to the succession of 2 Jackson Hole speeches he gave. And in fact, the unemployment rate is still below their estimate of the natural rate. Aggregate demand still has considerable momentum. So they got inflation down considerably without nearly as much pain as they thought, but they're not done. And the risk is the pain's to come.
Let's talk a little bit more about that risk, Lindsay, because we have seen the bets increase for a soft landing. There is, though, that risk that Vince was just talking about there that we could possibly see a recession. How confident are you that we are going to see that soft landing?
I think right now there's the possibility of 2 scenarios playing out. The Fed remains on the sideline. They take this patient position. They allow the economy to slow as projected. We get a non-accelerating economy, meaning around 1%, but we may not see inflation come down to 2%. It may be lingering around that 3% level. Now, the Fed may be willing to tolerate a slightly higher level of inflation in order to achieve that soft landing. But if they decide that 2%, that is the target, that's the hard level, then maybe the Fed will be forced to come back in and raise rates again or take additional policy action, then forcing the economy to slow even more. So again, it's still a very uncertain outlook for the economy where a soft landing may lead us into more of a stagflation scenario.
Lindsay, you mentioned that inflation level. Do you think the Fed should, or would it make sense for them to settle for something above that 2% level?
I think that's very dangerous, and that's a very slippery slope. They need to be very clear that 2% is their target, and they will not tolerate an above target level of inflation. Because if that is the case, the market may start to anticipate higher and higher levels of inflation, driving inflation expectations higher, which becomes a self-fulfilling prophecy.
Vince, I want to bring you back in here. I mean, ultimately, when we think about getting to that 2%, a 2-handle just will not do, it sounds like. So at the end of the day, for the Fed that has already indicated higher for longer, at what point do they say, okay, we've seen enough in the data to begin cutting?
You have to take your choice, and it really depends on how hard the last mile is. If Jay Powell gets his fondest wishes and the last mile in reducing inflation to goal is relatively straightforward, then they can lower the nominal funds rate as inflation basically painlessly comes down. That takes some time, and it won't be till later in the year. But he could be wrong, and getting that last mile accomplished could be quite hard, in which case you got 2 choices. They put off tighten up easing much longer than market participants currently expect. That means there's going to be a lot of disappointment in the bond and equity markets for the first part of 2024. Or, as Lindsay suggests, they give up. They get to an inflation rate in the neighborhood of 3. Maybe it gracefully starts with a 2-handle, and they say, we have a forecast in which it ultimately will go down to goal. We'll have opportunities to get it surely at goal in the future. Why don't we stop now? And so those are your 3 choices. Either it works, it doesn't work and is painful for bond markets, or it doesn't work and it means in the long run we have a higher inflation rate. And the Fed basically gave up.
So, Lindsay, what do you think that timeline looks like for the first rate cut? What do you think is most realistic at this point, given the fact that there's still more work to do?
Well, based on the Fed's consistently overly optimistic forecast for inflation, I do think it's going to be a longer timeline to achieve a relatively stable or acceptable level of inflation. So beyond 2024 into 2025, most likely. So I do think that the first rate cut is going to be pushed off to the second half of next year. So certainly, again, a possible disappointment for the market that's pricing in the first rate cut as of the first quarter. I don't think the data is going to be improved enough to justify the Fed to shift into rate cuts. Further stability in rates, possibly, but not that first rate cut until we see more downward momentum towards that price stability level.
Great to get both of your analysis here on the matter. We're going to have a lot more conversation going into next year on this. Vincent Reinhart, Dreyfus and Mellon, Chief Economist, and Lindsay Piegza, who is the Stifel Chief Economist. Thank you both for taking the time here.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
Argentina's peso plunging in value relative to the dollar this week. It's in relation to some shock measures implemented by Argentina's new presidential administration in an effort to get the country's long-floundering economy back on track. Yahoo Finance's Julie Hyman is here with a closer look. Hey, Julie.
Hey there, Shauna. Well, Argentina's new economic policy can best be summed up with a chainsaw. Seriously, now President Javier Milei wielded the power tool on the campaign trail to illustrate his plan to fix Argentina's staggering economic woes. That is, cuts, cuts, and cuts. In his first full week in office, Milei's administration unveiled some of those policies, among them slashing energy subsidies, halving the number of ministries, and devaluing the Argentine peso by more than 50%. That last move sending the currency tumbling against the dollar. I mean, this move is very dramatic. So it's now 800 Argentine peso to $1. A very dramatic move among a host of dramatic moves. All of this as the government is up against some pretty staggering numbers. Argentina's inflation up 12.8% in November. That's month over month, year over year, 160% higher. How did things get so bad? Put simply, for decades, the Argentinian government spent like crazy, and the central bank printed money to finance the resulting debts, devaluing the peso in the process and driving up inflation. It's that out-of-control government spending that Milei aims to tackle with his blunt spending cuts. But those policies take time to have an impact and, importantly, in the short term, Argentinians will feel the pain. That pain, by the way, torpedoed past efforts by past presidents like Mauricio Macri to make cuts. But analysts say this time Milei and his team have better communicated what's to come. That doesn't mean, though, that the people are going to be happy with it. Reduced government subsidies still mean higher costs for utilities and public transit. Import costs will soar as well, thanks to that devalued peso. A brutal drought earlier this year also took a toll on the economy's crucial farming sector, contributing to a 4.9% contraction of the nation's GDP in the second quarter. And the annual inflation rate could likely get even worse before it gets better. JP Morgan out with a note yesterday projecting inflation to hit 210% by year end and then stay elevated through the next year, guys.
So a lot of people might be wondering, Julie, why does this matter to U.S. investors?
Well, it matters to the global economy. And a lot of folks I spoke to about Argentina said it matters because it's a fascinating experiment here in Latin America, a really important and interesting region where this is not the only country that has this problem. I emailed with Ian Bremmer, of course, of Eurasia. He called this a laboratory for market reform, and it's going to be really interesting. He says if Milei fails, the default could be more difficult to sort out than past restructurings and could also have a ripple effect throughout the region. Also talked to Peter Bookvar, another well-followed market strategist. He called what's going on one of the most exciting and interesting economic and political experiments and stories to come around in a long time. So there's a lot at stake here for Argentina, but also as potentially a model for the region. There's some cautious optimism here, but there are a lot of questions about whether it's going to work because it's going to be very difficult for everyday Argentinians to get through this period, guys.
Really great synopsis, Julie, and that chainsaw image is living rent-free in my head right now. Much more to come on this story, I'm sure. Yahoo Finance's own Julie Hyman breaking down all things Argentina here for us this morning. Thanks. Let's take a quick look at the markets here as we've got the Dow, the S&P 500, and the Nasdaq in positive territory, clinging to gains the best it can. The Dow Jones is right now. It's up by about 0.03%. The Nasdaq up 0.5%. S&P 500, you're seeing that up by about 0.2%.
All right, well, that does it for us today on Yahoo Finance. We are going to hand it over to Yahoo Finance's Rochelle Akufo, who is going to take you through the next hour of trading, digging more into the market's municipal bonds, and a big interview with Gary Black, the Future Fund LLC managing partner, on the state of Tesla and the year that it has had. She will be joined by our very own Praz Subramanian for that. We will see you on Monday. Have a great weekend, everyone.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this morning. Stocks are on track for the fifth straight week of gains as investors bet on future rate cuts from the Fed. But will the rally continue? And a roller coaster of a year will break down the most consequential things to happen to Tesla in 2023 and what investors should expect for the road ahead. Plus, gaining momentum, Amazon is looking to take back its customer base in China. That's after losing ground to Shein and Temu. The moves the e-commerce giant is making coming up this hour. But first, let's take a look at how the major indices are faring an hour and a half into the trading day. Looking at the Dow, relatively flat there, up about 18 points on the day. It has been oscillating quite a bit this morning. Looking at the S&P, also up, but just ever so slightly there, up about 4 points. We're seeing tech leading the charge in terms of sectors, utilities and healthcare, the big laggards. And the tech-heavy Nasdaq there, also up more than 0.5% there, up about 77 points so far this morning. Let's also check in on the Treasury market as we've seen bond yields retreating after those signals from the Fed about rate cuts for next year. Looking at the 5-year, currently relatively flat though. Looking at the 10-year though, far off that 5 mark that we saw earlier this year. And the longest term 30-year, that's also down about 0.7% on the day. Well, the everything rally is on. Although stocks are searching for direction today, the Dow really jumping around, but they are on track for their fifth week of gains. Here to break down these market moves is Yahoo Finance's own Madison Mills. Hey, Maddie.
Hey, Rochelle, thanks for having me. So it's interesting to see how the end of this week is shaking out because we got some Fed commentary this morning from Williams that put a little bit of fear back into the market, but not so much. And I'm going to walk you through it. So starting with the Dow Jones Industrial Average, this hitting that 3,700 mark this week, a record high, as we know. And you can see right here, that's Jay Powell talking earlier this week, leading to that big leap ahead in the Dow Jones Industrial Average. But you can see today a little bit of flattening here. Now, that's coming after that Fed commentary from this morning, but it's also Triple Witching Day, one of my favorite personal holidays. We've got a lot of options expiring later today, record-breaking amount, and that is leading to a little bit of a risk-off trade on the day. Having said that, though, not so risk-off that we're seeing any sort of negativity when it comes to the Magnificent Seven stocks. And I just want to take a look at the Nasdaq year-to-date, up a whopping 40% here, so seeing a lot of those big returns in the Nasdaq index, which is going to be more weighted to those tech names, as we know. Having said that, though, the Russell is getting a lot of attention this week because the idea that the Fed could be cutting rates next year is a boon for those small cap names. Also, from a technicals perspective, the small caps tend to do well towards the end of the year, and that's obvious. If you look at that bump right there that we're seeing, small caps do well heading into January. That's something called the January effect. Traders looking to prove that they made profits for their clients throughout the year tend to try and get into small caps towards the end of the year because they're a little bit cheaper, lower valuations. You can get in, the stock goes up, make a little bit of a profit there. Interestingly, I also want to, if I can figure out how to do it, this is one of my first times on the board here, but I want to look at some of these specific tech names because Microsoft, for example, you saw hitting into the red a little bit this week. A name like that has such a strong weight in these indices that it's going to pull it down a little bit. We saw some margin covering from the street, which led to a little bit of that red. We're also seeing some of the other tech names dipping in and out of red today. That is going to make it challenging for a lot of growth to happen throughout the day. But stocks, like you said, Rochelle, still on track for their fifth week of gains heading into the close.
Indeed, the Fed stealing some of Santa's thunder there to end the year. Appreciate you breaking that down for us. Our very own Madison Mills. Well, as we mentioned, the Federal Reserve gave investors their ideal scenario at Wednesday's meeting, signaling rate cuts in 2024. And with inflation falling, the labor market holding steady and consumers remaining resilient, stocks seem to be on track for a Santa Claus rally. But will the hype continue into the new year? Recent data shows that there's about $6 trillion of cash sitting on the sidelines as of December 6th. That stockpile is in the money market fund assets, and if thrown into equities, could fuel a surge. Joining us now on this is Bill Northey, U.S. Bank Wealth Management Senior Investment Director. Thank you for joining me this morning. So give us some context here. Obviously, we have this everything rally here, a lot of investor hopes about just how much and how quickly the Fed is going to cut rates next year. But this money that's been on the sidelines, what does that add to this?
Great to be with you, Rochelle, and happy holidays.
We've certainly seen just a furious rally since the October CPI print, which has been confirmed by subsequent data, and it's lit a fire under the equity markets. We've seen the S&P 500 up 15%, small caps, as you pointed out in the prior segment, up even more at 20%. And notably, it's impacted bonds as well, where we've seen yields come down over 100 basis points on the 10-year Treasury. So the everything rally is certainly an apt description for what we have seen since that more favorable inflation data that has allowed the Federal Reserve to pivot. There's a lot of cash on the sidelines. We see this trend likely intact at least through the end of this year. But we have to acknowledge as we move into 2024, it is going to be a somewhat slower environment. Earnings expectations may be elevated relative to what we can actually deliver, and valuations are at the high side of fair. So there are risk factors that we need to acknowledge as well in terms of portfolio construction.
So let's break down some of those risks so that people can sort of look at how they're positioning their portfolios. When you have an everything rally, it can be hard to get when you get lost in the hype there. What are some of the specific catalysts that you're focusing on for next year?
Well, I think specific catalysts in terms of things that can propel us forward, we are likely to see, consistent with our view, a soft landing next year where we don't experience a recession, but do experience some degree of slowdown into the year. But a recession or periods of contraction is a non-zero probability, and we need to respect those risks. Some of the factors that we need to be able to evaluate are those lagged effects of the cumulative monetary policy tightening that is already in place. And even if that's reversed as soon as March of next year, which is where the futures markets are pointing, we still have to chew through the prior actions and the impact across the manufacturing sector, which is showing more signs of weakness than we're seeing within the consumer and the services sector.
And speaking of the consumer, obviously, as the Fed looks at the whole picture, it's the labor market, it's also the consumer, surprisingly resilient in November as well. How does that set some of these expectations up for the markets versus what the Fed is now saying, especially this morning, some of that Fed speak dialing back some of that enthusiasm?
Well, there's clearly a difference or a divergence that exists between market pricing and what the Fed laid out as recently as this week in their summary of economic projections. If you look to the Fed funds futures markets, there's an anticipation of 150 basis points or 6 full cuts, 25 basis point cuts next year. And of course, there's a lot of runway between here and the end of next year. So the range of outcomes is somewhat wide. But that diverges by the 75 basis points that was laid out in the SEP. So there's reconciliation that needs to occur, and market volatility always occurs when there are changes in those expectations, incremental changes in those expectations. So we must be very careful about watching the incoming data, consistent with what we heard from Fed Governor Williams earlier today. We are in a data-dependent mode, and there are a lot of potential outcomes that can still yet occur through the course of 2024.
So as people try to adapt their portfolios, as the Fed at least hints at signs of pivoting here, where do you see the opportunities and what are you steering clear of?
Sure. So as a firm, we have been in a position of consistent with long-term investment policy targets. So if you're a balanced investor that calls for a specific allocation to equities, fixed income, and real assets, which is how we construct portfolios here at U.S. Bank Wealth Management, we would be consistent with those targets at the top level of the portfolio. We do think there are opportunities down beneath that level in terms of allocating within equities between the various equity market caps and geographies, and also within fixed income, where we are neutral duration, but we think there are opportunities within credit and namely within non-residential mortgage-backed securities for taxable portfolios.
And so people who are looking at sort of the risk appetite right now, I know you said you're taking that long-term view. Any perhaps riskier sectors or perhaps some sectors that are being undervalued at the moment?
Well, this has been an incredibly narrow market, as we've heard on your channel and many other places. It's been narrow leadership from the Magnificent Seven, only 3 of the sectors of the S&P 500 outperforming the S&P 500. And the top 10 stocks represent 33% of that index. So to the extent that we can potentially see some broadening out in a slower environment, there's a lot of opportunity for catch-up trade, both within sectors that did not perform as well in 2023. So thinking some of the more defensives, the cyclicals, and the rate-sensitive sectors, And then also, as we think about going down the capitalization scale, if we experience a soft landing, there may be an opportunity for some of the more challenged small cap companies to actually perform better than expected. But broadly speaking, as we move into next year, we do expect that 11%, which is the consensus for S&P 500 earnings growth, may be somewhat too aggressive for what the economic reality will afford.
Certainly that reality check will come to you, especially as we continue to hear more from the Fed. Appreciate you joining me this morning. Bill Northey, U.S. Bank Wealth Management Senior Investment Director. Have a great weekend.
Thank you, Rachel.
All right, time for a look at today's trending ticker. Watching shares of BlackRock dipping today after getting a downgrade from JP Morgan to neutral from overweight. The analyst saying in a note to clients that the iShares US Equity ETF outlook is more challenged than some think. The asset manager stock has surged 25% so far in the fourth quarter, as investors expect the company to benefit from a transition to fixed income ETFs. But according to JP Morgan, the magnitude of the transition may not be enough to justify further share price outperformance. Now, this comes, of course, as BlackRock is making its bid to the SEC for a Bitcoin ETF. We'll be tracking that progress in the new year. All right, we still have all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Shares of Lennar are falling after the company reported its fiscal fourth quarter earnings. Despite beating the street's revenue and adjusted EPS expectations on steady demand for deliveries, the home builder reported a gross margin that was narrower than analysts forecast. Joining us with more on the home building sector is Yahoo Finance reporter Danny Romero. So, Danny, how did Lennar compare to its competitors this quarter?
Look, Rochelle, Lennar posted stellar fourth quarter earnings results, but that came with a cost, and that's what investors aren't too happy about. Lennar is forecasting lower gross margins on home sales and for next year in their first quarter. The builder is expecting gross margins to be about 21%, while Wall Street is expecting about 22%. I'm hoping that they do reveal a little bit more commentary on this front, given that the earnings call is underway right now. But let's highlight some of the gains this quarter. Quarterly starts were up 43% for the 12 months ending in November. New orders also got a big boost, jumping over to 17,000 orders. This was a 32% gain and well above Wall Street expectations of 16,000 new orders. The builder also delivered over 23,000 homes. That's a 19% increase. So these results really do highlight that the housing activity did not diminish as mortgage rates were rising. Remember, in October, mortgage rates were hovering over 8%. And Lennar, I want to highlight that Lennar differs from its competitors like Toll Brothers. They sell homes after completion. This has been a strategy that has worked for them. We're obviously seeing in the results this quarter, but again, we'll have to see a little bit more commentary on what happens, what their outlook is, specifically if they'll tackle about this whole commentary on gross margins. But we'll have to wait and see. Like I said, the earnings call is underway, Rochelle.
So then, Danny, with that in mind, looking ahead to 2024, what are analysts saying about the building sector there?
JP Morgan is ditching its view on their building products sector. The reason is they say that the new home construction has really taken over the resale market. And the fact is, a lot of remodeling activity does happen on the existing home sales front, and that has been very muted this year, given the fact that mortgage rates have been hovering. But JP Morgan is favoring stocks that really have a lot of high exposure to new residential construction. Some of the stocks that they really do like is Top Build, which is ticker BLD. Another one is Installed Building Products, which is ticker IBP. And the bank's view really does highlight how the home building stocks have really been on a tear this year. And, obviously there is some bullish view on that front. But again, JP Morgan noted that the home building universe of stocks is up 70% this year compared to the building products, which is only up 55% overall. So this really does highlight where JP Morgan is headed. We could see other analysts also head in this direction, but I guess on the home building front, they are still maintain their bullish view. Rochelle.
And it's interesting, you mentioned those different approaches to it, as we saw with Toll Brothers, when you have, such low inventory and people really clamoring for these houses, clearly making the difference there. Appreciate you. Our very own Danny Romero. Well, the bond market has been on a wild ride lately, but despite differences in opinion on the direction of rates, treasuries are still considered one of the safest assets to own in times of uncertainty. Munis, or municipal bonds, are part of that conversation. But some big moves today. We heard Citigroup is shutting down its municipal bonds business. Certainty there are some headwinds that the asset class has faced. But with bond market improving over easing inflation and the Federal Reserve signaling 3 rate cuts in the new year, we're seeing renewed interest in the asset class. Let's get a read on muni bonds with David Hammer, Head of Municipal Bond Portfolio Management at PIMCO. Thank you for joining us this morning. So talk about the landscape for muni bonds, because you're so welcome. A lot of people are more familiar with corporate bonds and treasury bonds. Talk about the space that muni bonds face here.
Yeah, well, muni bonds, the most common feature is that they are tax-free to U.S. investors in the top marginal tax bracket. And some key differences, the shape of the curve. Longer maturity munis today actually have higher yields than shorter maturity munis, much different than the treasury market or the corporate bond market. But just like corporate bonds, treasury bonds, muni bonds do expect to benefit from a change in posture here by the Fed. Inflation has peaked, The Fed told us as much yesterday, pricing in more cuts now in 2024. And the economy is beginning to slow. We see a stagnant economy here at PIMCO. That's a pretty good macro backdrop for muni bonds in terms of both earning higher tax-free yields, but also the chance to benefit from capital appreciation.
So then the move by Citigroup, the bank has said that they've not really seen the overall returns that they would have liked in the muni business. Is that something then that you expect to continue into 2024?
Well, one of the reasons that the muni curve is steeper, that longer maturities offer higher yields, is that banks have been less present. Their tax rates are lower today than they were before tax reform in 2017, moving from a 35% tax bracket down to a 21% tax bracket. So we do think banks are likely to be less present in the muni market. We see this as an opportunity for investors to really step into the void that they're creating here and buying bonds with higher yields than what we would have typically seen when banks were a bit more active.
And I want to ask you about the domino effect, because at the local level, at least, we see those sorts of bonds backed by property taxes. So when you look at what we're seeing currently with property taxes, what is that telling us about what to expect in the coming year?
Yeah, it's a pretty positive indicator for local muni credit quality. Most local muni bonds, they're backed by property taxes. And the repayment mechanism, it's based on what are houses worth versus the assessed values. And what's fairly typical in the muni market, assessed values lag. And that's happened over the last couple of years here. Home price appreciation is up 10, 15, 20% in some local areas. Muni bonds that are backed by property taxes, the assessed values, so where are they on the tax roll, those are just beginning to catch up. It takes time as property values are reassessed or homeowners sell to new homeowners that pay a higher property tax. And that's really good for local credit quality. We expect a continued improvement over the next few years.
So, David, we know that so far, a lot of people still had some cash on the sidelines, or they reap the benefits of, investing in some of these short-term bond yields. So then what can they do at the end of the year, keeping taxes in mind as they're trying to invest in the muni bonds market?
Yeah, so I'd say two important things here. One is that the short end of the yield curve in the muni market, not the place to be in our view. Longer maturity bonds offer better tax-adjusted returns. An appropriately structured portfolio can earn 3.5% to 5% tax-free. That's equal to about 6.5% to 8.5% before taxes. So really near equity-like returns with less risk. And while there's no such thing as a free lunch, taking a tax loss is pretty close. And investors have the opportunity today to really re-examine their muni allocation, move out of maybe one mutual fund or one ETF or an individual bond into a different bond that potentially offers a higher yield and also lock in that tax loss to offset capital gains.
And so what would you say would be the biggest headwind for muni bonds in 2024?
Well, a lot of the headwinds that we've seen here have really abated. The last few years have been about higher inflation, higher interest rates, and outflows from the muni market. All of those look poised to reverse in our view. That said, there are some pockets in credit markets that are not as rosy as others. Areas that maybe haven't recovered as strongly from the pandemic, big urban areas, the transportation systems that support them. And then in healthcare sectors, so senior living, not-for-profit healthcare issuers that can access the tax-exempt bond market. They've been squeezed by wage inflation. It's really hurt their margins and their profitability. We think that's an area still to be a bit cautious if wage inflation takes a bit longer to ease in some of these healthcare-related sectors.
I appreciate you breaking that down for us. I don't think muni bonds get enough love in this environment. Appreciate you joining us. David Hammer, Head of Municipal Bond Portfolio Management at PIMCO. Thanks so much.
Thank you.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance.
New year, new outlook. As 2023 draws to a close, brace yourself for a riveting financial look ahead to 2024. Here's what we'll be watching. The soft landing debate. Are we heading for a recession? The AI hype cycle. Is it still real? And the 2024 presidential race. President Biden and former President Trump seemingly set to square off yet again. We'll break down how this election could impact your long-term investments, so get ready to uncover the insights, predictions, and financial secrets that will set the stage for what's expected to be a prosperous new year. Join us for our year-end finale that will leave you both informed and inspired.
It's an uphill battle for auto companies, but the recovery is expected to continue into 2024. Auto sales are expected to hit over 88 million next year, according to a new forecast from S&P Global Mobility, as supply chain snags recover and consumer demand bounces back. The report, however, does warn that fading demand and consumer uncertainty could impact future growth for the sector. Well, staying in autos, it's been a roller coaster year for Tesla, from slashing prices in the US starting in January all the way to the release of its much anticipated and controversial Cybertruck just last month. But what were the most consequential things to happen to Elon Musk's company this year, and what's still to come? Gary Black, the Future Fund managing partner, joins me now alongside Yahoo Finance's Pras Subramanian. Welcome to both of you. So Gary, I want to start with what you consider the most consequential story of the year for Tesla.
Well, Cybertruck is huge. Last time we saw this level of innovation is when they launched Model Y, and it created a halo effect for the whole Tesla franchise. You saw volumes explode in 2021 after Model Y came out. It went up 87% after being up, I think it was like 37 in the prior year. You're going to see a similar halo effect this time. People are lining up to go into the stores. They can't get a Cybertruck unless you ordered it 4 years ago. But what's happening is people go in, they learn about Tesla, and they buy a Model 3 or they Model Y. And I think that's probably the most important factor. You mentioned price cuts. Tesla took prices down earlier in the year. They didn't really get much out of it. I'd say it stopped the bleeding. I don't really think it was that smart of a move to do it. But on the other hand, their volumes for the year are going to come in at about 1.8, which is about 40% above where they were a year ago. And I think one of the things investors like me are looking for is, have the price cuts stopped? Will you see gross margins bottom either in third quarter or fourth quarter? And I think they have. So that's the second big story. The third big story is going to happen in a couple of weeks. You're going to see the $7,500 EV credit, which up to this point, you get to take it as a tax credit. It's going to go off invoice. And so immediately the prices of all Model Ys are going to effectively go down by $7,500. The Model 3 Performance will go down by the same amount. The Model X long range will go down by the same amount. And that's going to be a catalyst for the entire EV industry. So those are three big things that are happening.
Hey, Gary, Prost here. So talking about those price cuts, there was a lot of, hand-wringing about margin dip and when are we going to see that trough for margins based on the fact that, they're cutting prices to move volume. It sounds like you're saying that it wasn't that much, it wasn't a big player in terms of volume, but are you concerned about that margin story at all?
Well, it's hit, right? So look, Tesla's up 104% year to date. But fourth quarter of last year, you could see this coming because they started cutting prices in China. People started expecting the price cuts in the fourth quarter. So last year, if you look at fourth quarter of 2022, Tesla was down about 60%, Nasdaq was flat. So the market anticipated the price cuts, seeing that they were happening already in China. So margins have dropped, as you say, Prost, from 26% to about 16. I think they've bottomed. And as an investor, you're looking for, what's going to happen going forward. And I think you're going to start seeing margins creep back up. The Cybertruck is priced way above the rest of the Tesla franchise. So you're not going to see that many Cybertrucks delivered in 2023. We're expecting, some, maybe 100,000 in 2024. Once you get to 2025, that's when you're going to start seeing, the margin increase because of Cybertruck. So I'm not that concerned about the margin because that's already happened, right? But going forward, I need to see that it's stabilized and I need to see it start inching up as we get into 2025.
So Gary, one story that may not have moved the needle, but was I think, a harbinger of things to come was Tesla's charging deal with Ford that sort of upended that landscape and brought a bunch of traditional OEMs into the Tesla fold. I know that's not going to move the needle much from a financial point of view, but do you think that was a big story for them, a big kind of deal for them as we look forward into the EV transition?
Yeah, I don't think that's such a big deal because again, you're using the charging network, which is external to the car, right? I think a bigger story, which a lot of bulls are hanging on, I'm not in this camp, that FSD, that you're going to see a lot of legacy players decide to start paying Tesla for their FSD. That's the brains of the car. And so I don't see that happening. I think for, an external, you charge it using a Tesla charger. I think that's smart business for GM or Ford or Volkswagen because the number one reason people don't buy an EV is because of this so-called range anxiety. Probably the number one thing is cost. They think that the cost is high, even though after the credit, it's really not that. But number two is that they're afraid they're going to run out of charge. And if GM or Ford can say, look, you could stop at one of these Tesla superchargers, get your charge filled up in half an hour, and there's 20,000 of these in the United States, that relieves that range anxiety. So I think it's good for the other OEMs. I think it's good for Tesla too, because once you're inside it, the supercharger, the long-term bet is the next EV they're going to buy is going to be a Tesla. I mean, they're gorgeous. They have the longest range. They're the best value for the money. And I think once people drive a Tesla versus say, a Ford Mach-E or, some GM EV, I think you're sold. You don't go back to the other brands. Tesla has very high brand retention. So the goal is to get people interested in Tesla, let them come to the superchargers. They're going to see the other Teslas, and chances are that'll be the next Tesla that they buy.
And Gary, we certainly saw as people were interested in the Cybertruck, whether all of those, obviously those deposits translate into actual purchases, we still have to see. But it did draw them in. Perhaps I know that they were able to pay a bigger deposit to get to test drive it if they sort of looked at some of the other models as well. As we talk about the halo effect, though, we have to talk about the Musk effect. How much does people's actual visceral reaction to Musk himself affect whether or not people are going to be buying Teslas in 2024 versus perhaps seeking other options?
Yeah, I mean, people love Musk or they hate him, and there's no in between. You're right. There is a brand effect, and I would argue, the brand has taken a hit during 2023. And look, I'm a bull. We own Tesla. It's our second biggest position, so we're very bullish about Tesla long term. But you have to, even as a bull, acknowledge that the brand has taken a hit this year because of Musk's, whatever we call them antics. When he berates the advertisers and uses, a curse word because you caused advertising, that's silly. Okay, it's just it doesn't help the Tesla brand. And whether we like it or not, the Tesla brand is it's Musk is part of the Tesla brand. He's one of the few CEOs where when people think about the brand, they also think about the CEO. So I think people either love Elon Musk or they hate him. And I think, as long as he can kind of stand clear of the politics and stand clear of some of the right-wing extremist views that, he seemingly has embraced over in Twitter, I think the brand will be fine. We haven't seen any brand impact yet, other than they did have to take pricing down this year. And, if you're a bull, you have to acknowledge that margins came down a lot, prices came down a lot. Margins came down to Tesla more than any other brand this year. So one has to, if you're being honest with yourself, acknowledge there must have been some brand impact or they wouldn't have had to take prices down as much as they did.
Hey, Gary, so looking ahead to 2024, what are some of the key things you're watching for Tesla as we see the next part of the story unfold? And also, I know that you've been talking about how Tesla trading at, I think, 58 times adjusted EPS for 2024. You think that's cheap, right? So I want to get more of that story as well.
Yeah. So the big catalyst we're looking for is, one, we talked about auto gross margins have to bottom. They hit 16.3. This is excluding the reg credits. They hit 16.3 in the third quarter. We think they'll be about the same in the fourth quarter. Then we think they're going to get back into the 17 range in 2024. So that's the first thing that has to happen. Two, you have to see that there is some halo effect that's come from Cybertruck. We think we're going to see that starting in the first, second quarter. And related to that is that $7,500 EV credit, which is going into place off invoice in 2 weeks. Third, people are going to start talking about this other end of it, which is the $25,000 vehicle. To me, that's where Tesla can get, up to say 5 million units, because you're going into the mass market. And Tesla is viewed as a luxury brand. When you bring the brand down to the masses by bringing out a $25,000 vehicle and you put the Tesla brand on, everybody's going to want that. And they're going to get a $7,500 credit for that if they buy it inside the United States. So if it's, a U.S. delivery, you'll get that $7,500 credit as well. So I think those are the big events that we're looking for. And then the fifth one, I would argue, would be declining interest rates. We saw the Fed, pivot, for lack of a better word. They're going to start taking rates down in the spring. We could see that from the dot plot. That helps long duration growth stocks the most. Long duration meaning high PE, where the earnings and the cash flows are a couple of years out, because you're basically discounting those earnings at a lower rate. So that helps Tesla. So back to your second question about PEs, Tesla's trading at about 58 times my next year's estimate. People say that's expensive, but you can't, if you study finance, you know that you have to look at what is that relative to the growth rate, because the growth rate, if it's flat, like on a GM or a Ford, 58 times would be absurd. But if you're growing your volumes and your earnings at 25 on volumes and 35 at earnings, that's not really that expensive. So you look at something like Apple. Apple trades at about 30 times earnings today, but it's only growing at about 10% a year. So on a price earnings relative to growth basis, that's about 3 times. Tesla is trading at 58 times earnings, but it's growing its earnings at about 35% a year. So it's trading at a peg of about 1.8. So that's pretty cheap relative to other, we'll call it mega caps. Relative to Nasdaq, Nasdaq's trading at an overall peg of about 2. So I would argue that as long as Tesla can sustain its growth rate at 35%, it still looks pretty cheap. The reason it's growing so fast, though, is because EV adoption is soaring. If you look at Norway, you look at the Netherlands, you look at even China, you could see EV adoption going through the roof. It's not so much true in the US yet, but if EV adoption today, which is about 12, can get to 60 by 2030, which is our projection, that's about 24% tailwind growth just for the whole category. And in our view is that Tesla could gain share within the EV category because of its innovation. So because of Cybertruck, because of the $25,000 vehicle, and maybe you'll get some positive because of FSD, although we're not counting on that. That's the full self-driving.
And certainly that $25,000 price point and then the tax credit would certainly be a boon for people who are sort of still waiting on the sidelines. Appreciate you taking the time to join us this morning. Gary Black, the Future Fund LLC managing partner, and Yahoo Finance's own Price of Romanian. Thank you both.
Thanks, guys. Bye-bye.
All right, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Intel getting a boost this morning on the heels of its AI Everywhere event yesterday. The company unveiled a lineup of new chips and AI-centric innovations. Our own Dan Howley sat down with Sandra Rivera, Intel EVP and General Manager of the Data Center and AI Group, alongside Michelle Johnston, Intel EVP and General Manager of the company's Client Computing Group, to discuss innovations in the chip space and the impact of generative AI.
So for 5th Gen Xeon, we introduced a CPU that was really built for AI. We have integrated advanced matrix extensions, so it's just an AI acceleration capability into every one of the 64 cores. We have a software stack that unlocks all of the value and that underlying CPU infrastructure, and we have the security capabilities that our customers care about in terms of securing their models and their data when they're building AI solutions. So we're pretty proud today, not just in terms of the raw capability, but the way to unlock that capability through our software ecosystem and the partners that we showcased today at this event.
Yeah, there's a lot of similarities. Today we launched the Intel Core Ultra, which is our first CPU, processor, GPU, and NPU kind of all combined in one. And it's an amazing part. And we're really excited because it's a balanced part that allows us to really start and kick off the AI PC. And the AI PC is so exciting because, one, because we don't know what it's going to be, and because we have so many dreams for what it can be. And this is our largest architectural change in the last 40 years. And we have been able to bring discrete level ARC graphics into the processor as well as delivering our first neural processing unit, which allows you to drive and run AI workloads locally on your PC versus the way you've been doing it historically in the cloud.
So when it comes to the AI PC and doing things locally, what's the benefit there? Why wouldn't I go, hey, ChatGPT, for instance, give me a picture of a cow on the moon? Why would I want to do that locally rather than in the cloud?
Well, you want to do it locally for a lot of reasons, but one is just speed and time. The other is privacy and security. You may not want to be putting that information or what you want to share out on the cloud, and you want it locally. And so with the NPU, we have the ability to have that stored locally and that privacy, which is very exciting to be able to deliver that today.
I guess, when it comes to the AI data center, we just saw the Gaudi 3 was kind of a surprise unveil. What does that really do for Intel, and how does that line up with competitors like NVIDIA or AMD?
Yeah, well, one of the things we like to remind everyone is that AI is a very complex and wide-ranging set of workloads, meaning that you don't have a single design point for what customers need or want when they deploy AI solutions. So we know that we need heterogeneous architectures, different types of architectures, workloads that you can run best with a CPU, which is highly programmable, workloads that run best with a parallel architecture like a GPU, which we have, GPUs for data center and edge capabilities. And we also know that we need matrix types of accelerators, which is what an AI accelerator is. And Gaudi 2 and now Gaudi 3 is the best AI accelerator on the market that is really able to be deployed now to run specifically large language models in this generative AI phase. And so we call all that hybrid AI because we know that customers want to deploy in the cloud, on the edge, through the network, and then all the way out to client devices. And the unifying theme behind all of that underlying infrastructure is the software. And again, we talked a lot about the software partnerships, the ecosystems that we're investing in the client and in the data center. And this is the real unlock of the value of all of that underlying infrastructure.
Well, AI has been, to say it's the story of the year is an understatement, right? I guess, how is that driving decisions on the data center side and on the client side? How does that work?
Well, every enterprise has an AI strategy that they're looking to deploy. Every boardroom that exists for companies are talking about what is the AI approach that we want to take to increase productivity and efficiency, certainly from an enterprise perspective. And Michelle will touch on kind of the consumer applications that will also be created through the AI PC. But a lot of it is kind of still early days of, how do we measure the efficiency and the productivity gains? We know that for our own product development, we are actually using AI on the process technology side in terms of defect density and getting to better yields and better performance. On the product development side, shortening development cycles, getting better validation, being able to crunch a lot of data to pinpoint areas where we need to focus in terms of getting our products to market faster. And certainly in the enterprise where we just are using more AI and machine learning for increases in productivity, searching and finding information, summarizing information, and being able to run the existing ERP processes a lot more effectively, efficiently. Sometimes with less people, or sometimes making people more effective in their jobs. So it's wide open. It's exciting. It's early days, but certainly Intel has a critical role to play, bringing all of these different architectures and products to market and unlocking value through software.
Yeah, I think it's very similar. We're just in this transition to the AI PC, and so getting that infused into our hardware, both with the Intel Core Ultra you saw today, but future generations of our products, that's something that we're talking about from a development perspective every day. What does that look like today? What does it look like in 12 months from now? What does it look like in 24 months from now? And that is not just delivering the hardware, but working with that software ecosystem through our AI Accelerator program to really get hardware in the hands of those developers and to get that creative engine, or what we like to call that flywheel, really started. Because you deliver the hardware, but the real experience and the value of that comes from the software that's able to take advantage of it. And so, you know, whatever your killer app is, or something that used to be boring is now exciting again, because you have the opportunity to use and engage it in a different way. And so we're constantly thinking about how do we make sure that we have a constant drumbeat of products, of software, of ecosystem, and co-travelers that can bring and deliver that to the end customer.
Thanks to our very own Dan Howley for that interview. Well, Amazon is rolling out the red carpet for its China-based sellers. The e-commerce giant saying it plans to open an innovation center in China's Silicon Valley as it looks to challenge Shein and Temu's dominance. This comes as Shein reportedly filed for an IPO, and Temu's market share has been skyrocketing in the US. For more on this, Yahoo Finance reporter Brooke De Palma is here with more. Give us the lay of the land here.
Good morning, Rochelle. Well, certainly this is all in a bid for Amazon to compete with those rising stars like Shein, Temu, and others that we know, like even Walmart's growing marketplace. But this innovation center is just one of the many announcements that Amazon shared during a 4-day event that it held in China. Other initiatives that the e-commerce giant announced include its plans to allow Chinese sellers have access to its supply chain that announced back in September here in the U.S. So that means that these sellers will have access to Amazon's warehousing, distribution, and couriers, really a one-stop shop approach that Amazon is doubling down on for its merchants. The Amazon also hinted at an upgrade to its selling platforms and shared that it's also exploring the use of AI. And this comes as we've seen China sellers grow on their platforms from October of last year to September of this year. The number of Chinese sellers that sold more than $1 million on Amazon jumped by 25%, and the number of sellers that sold over $10 million increased by 30%. And this is just yet again the latest effort by Amazon to compete with those other marketplaces. Just last week, they cut fees for merchants. Now seller fees were reduced for products below $15 to 5%. For products that are $15 to $20, that fee is now 10%. Now, they were previously 17%. Those lower fees will go into effect early next year on January 15th. But once again, they're competing to get these sellers on their platform, especially when these other players are coming in with those low-priced apparel. They want to make sure that these sellers are coming to them and ultimately making more money on their platform at the end of the day. And Rochelle, it's also important to note that it's not just Shein, it's not just Temu, and it's not just Walmart anymore. We also see now TikTok getting in on TikTok Shop Live as well. And so many players really looking to take advantage of the boom in e-commerce that we've seen in the recent years.
Indeed, especially younger shoppers. Those seem to be the platforms they're always talking about. Appreciate you, as always, our very own Brooke De Palma. Thanks so much. Well, out this week, retail sales beating economists' expectations in November as the consumer stayed robust. But department stores were some of the biggest losers of the month. Shopping was down in that category by 2.5%. Now, that's not new. The category has been experiencing headwinds thanks to competition, change in shopping preferences, and store closures. Hundreds of big box retailers shuttering their physical locations this year. It begs the question, how do physical retail stores impact online sales? Well, in a new report out by the ICSC, all retailers experience an 11.5% drop in online sales when a store shuts down. Well, to break down the report, Tom McGee, ICSC CEO, is here. Thank you for joining me this morning. So, talk about the halo effect and then obviously the reversal that we see in the halo effect when a physical store shuts down.
First of all, good morning and thanks for having me on. As you mentioned, the halo effect, which is really our terminology around the positive impact that stores have upon online sales. We've talked about the omni-channel environment in retail really for the last decade or so. And ICSC has conducted a series of studies around quantifying that effect. This most recent one is the third one in the installment, which we looked at $850 billion of transactions, both in-store and online over the last couple of years. And we discovered that when a retailer opens up a new store, it in turn increases online sales by almost 7%, 6.9%. And to your point, when a retailer closes a store, that has a negative impact upon online sales of almost 11.5%. And opening up a store also increases the average basket size of people's transactions online by almost 11% as well, going from an average basket size of $94 to $104. And so there's really a synergy here between online and physical stores, and it's not surprising. I mean, we've learned that retailers are using stores as really not just for traditional shopping, but as really mini fulfillment centers to support their online sales activities.
And when you look at some of the hardest hit sectors, we're looking at some of the home stores there as well, some of these discount stores. How much of that is part of the inflation story versus sort of this really coming down to a changing consumer and younger consumers with different shopping habits?
Well, you know, I think obviously the impact on retail of inflation and the interest rate environment has been well spoken about. But you know, you mentioned younger consumers, and really, while younger consumers, technology is integrated into their life very much so. It's really integrated into all of our lives. But what we found in this Halo report, we looked at Gen Z and specifically, and while they use technology and use TikTok and social media to talk about their life events and share their life events, they really prefer online shopping. And they really prefer physical shopping versus online shopping, and they enjoy that experiential element of shopping in a store. And so they're very much consistent with what we see in the boomer generation in that regard.
So then what's going to be the key for retailers in 2024 to really tap into this? I mean, you've got your digital, your physical, your virtual presence as well. You have younger consumers who perhaps, didn't grow up in like the heyday of like seeing all the malls and a lot of the TV shows and things. So how does that line them up for 2024?
Physical retail right now is very hot, particularly suburban retail. There hasn't really been much construction of physical retail in this country for the last 15 years, but yet retail sales have almost doubled during that period of time. So you really have a mismatch where demand is kind of outstripping supply right now. And so a lot of retailers are looking to open up new spaces because of this synergy between online and physical retail that need to support their online sales using stores as mini fulfillment centers. So I think you're going to continue to see that take hold. I expect the retail environment in 2024 to continue to be strong. We've had some recent, positive news around the economy, and certainly employment continues to be strong. And as long as the employment market continues to hold and you see moderating inflation, I would expect retail sales to continue to be strong in 2024.
Certainly consumers have been hanging in there. As we mentioned, though, with wage growth as well, people feeling better about continuing to spend. Appreciate you joining me this morning. US ICSC CEO Tom McGee, thank you so much and have a great weekend.
You too.
Thank you. Well, that does it for now. I'm Rochelle Akufo, but stay with us on Yahoo Finance.